We're going to call our meeting to order June 12th, 2017, the Insurance Committee. If you would please stand where the prayer will be led by Commissioner Goddard, pledged by Kenny Downs.
Please bow our heads. Lord, thank you so much for allowing us to convene here today. Lord, thank you so much for the rain that you have sent us. It was much needed, Lord. We just thank you for all the blessings that you give us. Help us to hand blessings to others, Lord. We ask these things in Jesus' name. Amen.
Amen.
Pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
All right, thank you. And again, Tony, we're sorry we didn't let you know about the meeting, but we'll do better in the future. Starting to my right, committee members, would you introduce yourself, please?
Charles Overture, Supervisor of Elections.
Brenda Bridges, representing the Honorable Linda Myers, Putnam County Tax Collector's Office.
Kenny Downs here for Tim Smith.
Chip Leibel, Putnam County Commissioner.
Buddy Goddard, Putnam County Commissioner.
Bill Pickens, Putnam County Commissioner.
Gator DeLuch, Sheriff.
Clay Davis, Property Appraiser's Office.
Brian Hammonds, Planning and Development.
Press Tompkins, Public Works.
Bob Sender, IT.
Tony Costin, Carpenters Union.
All right, and I'm Larry Harvey, County Commissioner and Chairman. Let me kind of tell you why we reconvened this meeting today as we did, and then we'll go into some other explanations. After the last meeting, as probably all of y'all do, you rehashed the meeting that you were just in and trying to figure out things. And Mr. Davis had brought up some questions concerning the number that was used in the self-funding arena. That number was consistent across the board through all the quotes. You remember that, Mr. Davis?
I do.
I went over and spoke to Marjorie and pulled out the papers that were provided to us on a disc, and I overlooked it and saw where we should have been using, or we should at least consider, the provider number that was listed there. So no fault of Marjorie's, we just should have added another little line there that said this is what, because Marjorie built her recommendation on 12 months of claims plus 15% as she was instructed. But the provider provided us a number that was more consistent to what they felt their underwriting would support. So Ann, I'll turn it over to you now. You've got some handouts that you want to deliver, and that's the reason we're here today, because this will come back up, and we need to make sure that we've done everything possibly right when making our decision today.
Okay, thank you very much. Hello, everyone. First of all, I'd like to thank this committee so much for all their hours of time reviewing all the information and the time that it's taken to get to where we are today. I know it's a long, arduous process, so thank you very much. As promised, we do have the information. I have the original spreadsheet here. It said self-insured. I think it looks familiar to all of you. If you need an extra copy, I can provide it to you. What this spreadsheet was that we're going to hand out in just a minute, there's a line in red, and that's taken the numbers from what the vendor submitted. However, you will notice one of them did not provide that information, as well as the 5 self-insured bids separated by bidder 1, 2, 3, 4, 5, and their actual pages from the bid document that were on the diskettes that were provided to each of you. So I would like to pass this out, and then we can discuss it.
All right, good deal.
Give me a hand with this.
We took those numbers right off of the providers. We're going to be asking the providers today if those numbers are correct. That was based on what we could find out, and I already got one, thank you. So we're going to move into that arena. Providers, thank you for showing up. When we get down to the explanations or questions that we have, we're going to close our public portion of the meeting and move you all to another room, and then bring you in one at a time because proprietary information you might want to share with this committee that won't become public until after the fact of when we award the bid. So just for your information, y'all are going to another room away from here, not even in the next room over, because that room has sound over there, and we want to keep it as fair and equitable as we possibly can. So if you have any questions, we'll entertain that. But for the meantime, go ahead, Ms. Allen.
Okay, well, when you look at the large spreadsheet, it has 2 pages, Part 2, Health Self-Insured. You'll see the line that has been added that states vendors' projected monthly claims. And you will see that that has been inserted, but we have not adjusted the bottom line. We wanted to make sure today that we had calculated this information correctly, and that's why we're going to ask each vendor, if they're here, to help us in that calculation, because it's not exactly the same for each vendor in their response. So that's one thing that made it very difficult to summarize this information. But we wanted to make sure that everyone felt comfortable with this process and what it would entail.
Okay.
Okay.
Are we ready to move forward?
I think we are. Since this information that's been distributed is still not public record, and if we have conversations with each of the vendors, we have to make sure that it's closed to the public. So at this time, Chairman, with your permission, we'll do whatever we need to do. But I would first like to ask if we could find out what groups are represented here today, if we may.
Please do.
Thank you.
If you will, if you represent a group, would you just one at a time come up to the microphone, introduce what group you're here with, and then we'll know who's all here. Thank you.
Good afternoon. I'm Tamara Volkert with the Florida Sheriff's Multiple Employers Trust.
Thank you.
Good afternoon. My name is Robin Stearns, and I'm also with the counterpart Bill Abrahams with United Healthcare.
Good afternoon. I'm Mary Beth Donaldson, and I'm with South Georgia Benefit Administrators.
Good afternoon. Andy Carroll with Florida Blue.
Good afternoon. Colby Jackson with Aetna.
Thank you. Thank you. All right, at this time, if it's okay, we're going to close our public portion of the meeting. Melissa, would you like to walk them all over there to the other conference room? And if you'll come back then. And we're going to stay, why don't we stay with Florida Blue first, and we'll go through our spreadsheet from left to right. So Florida Blue, you can stay in the room. We're going to come to you first. Attorney, is it safe to go forward?
Yes.
Thank you. Okay. Again, introduce yourself. And
Yes, Andy Carroll, Florida Blue.
Hello.
C-A-R-R-O-L-L.
Okay. The questions that we have for you, at least that need to be brought out since we haven't been able to share, is the fact that your bid, your self-insurance bid, it seems to us that your projected monthly claims are somewhere in the area of about $334,000 a month. Is that correct?
Depending on which specific level you're looking at.
Looking at the option 150.
150,000?
Yes, sir.
The annual expected claims that was quoted based on the census that was provided is $4,019,221.
Okay.
So divide that by 12, which.
That's what I did.
Okay.
Okay, so that got us to the 334. How comfortable are you with that number? And the reason being is we used a number of 493 as the 12 months claims with the 15% on there. So it's important. That's almost $160,000 a month difference. So how comfortable is your underwriting staff with that number?
So just to be completely clear here, and I don't know what the other providers have provided, but the request was for a 12-12 contract on the stop loss, which means claims incurred in 12 months and paid with 12 months. To compare that to a fully insured number is not comparing apples to apples, because a 12-12 number is not a fully mature number, okay? So if you are comparing this expected claims number to the fully insured number, you're not comparing apples to apples. Now, to mature a 12-12 contract, you can estimate anywhere between 15 to 20% more to get the run-out claims that would be incurred in that 12 months but had not been paid in that contract period. So the $4,019,221 is a very accurate number for a 12-12 contract at $150,000 specific deductible. If you were to annualize that out, and if you're trying to compare it to a fully insured number, if you take the 15 to 20% buffer, depending on your comfort level, it comes out very close to what our fully insured number is.
Okay. All right. So with saying that, then, it appears to me that your total hard cost inside Florida Blue is about $64,075.79 a month. Would that be?
Which option?
Well, we're the same option.
Okay,
the option 150.
So the 12-12 contract, 150,000 spec. The annual cost is $369,797 for the specific. The annual cost is $19,324 for the aggregate coverage, and then the administrative fee is $60.48 PEPM. So depending on, my census was a little bit different. It came in just under $60,000, but that's within the ballpark of the number that you're providing, yes.
Okay. Ms. Allen.
Yes, sir.
Would it be appropriate for me to pull that out now?
I think so. I think that would be very helpful. Visuals always are more helpful, I think.
Marjorie, come here for a minute, please.
Andy, right here. Mr. Carroll.
Yes.
What was that last figure you put out?
So if we're looking
admin?
at the total premium for basically what are called fixed costs, which is your administrative fee, and then your stop loss charges, your administrative fee is $60.48 per employee per month. Your specific cost is $369,797. That's for a 12-12 contract, 150,000 spec. And your aggregate reinsurance cost is $19,324 using the census that was provided.
All right, Andy.
Chairman, if I may, that information's in the quote information they provided. Yeah, it's right here on option 1.
Okay, I didn't see it. I hadn't been to the little page
Okay.
yet.
Well, here's what I've been doing in my spreadsheet. So Andy, I want you to take a look at this.
Okay.
And again, these are my numbers. So if something's off, it might be off. You just said a number of $60,000 a month was a fixed cost that you came up with, and I came up with 64. I just want to drill on the concept and maybe not the numbers to that extreme. So if you look at the hard cost, if they are $64,075.79, with the claims, and Margie, if you'll turn a little this way too, with the claim projection on a monthly basis of $334,936, brings you a total monthly cost of $399,1179 times 12, which puts us at an annual cost of $4.7 million. Okay. If we went self-funding, if the county can only contribute $3.5 million, that leaves us $1.2 million short. Everybody see that? How that's going? The employee's current cost was $958,067.52, which now leaves us continually short at $330,073.96. If you divide that by our number of employees, 532, that's a total liability of $620.44 per employee divided by 52 gives you an idea of you would raise their rate $11.93 per week if you put it all on the back of the employees. So I think that's going to be really good information for us to have. And we realize self-funding is going to be difficult this year. We realize that. But it gives us a potential savings of $1.4 million. And at the last meeting, yeah, I'll be there. The last meeting was, could we afford to take that big of a bite out of the apple or not take that big of a bite? But I wanted you to have these numbers because it was important to know that Blue Cross, or Florida Blue, I'm sorry, has basically, you said that was the 334 was an accurate number that you proposed for a 12-12 plan. So within 12 months and there's no tail, it's going to stop after, it's not 12-15 or nothing like that. My point here, ladies and gentlemen, we could see a potential savings if we went the self-funded market, but we don't know. We got to decide as a committee and as a county if that's something we want to do. But I wanted you to have the right numbers. Ms. Papel, you have the floor, and then I'll open it up to the committee.
I would like to ask a question. Okay, this is a 12-12 contract.
You're going to have to talk closer to that.
This is a 12-12 contract.
Yes, ma'am.
So say this scenario happens. We do go self-insured. We have higher claims than anticipated, but still under the stop loss. We decide to change course entirely and go back to full insurance 1 year out. There is no tail. There is a tail, right? And conceivably a large tail.
I can clarify if you'd like me to. So this will hold true for whichever carrier you're referring to. So this is more educational on how the reinsurance contracts work. A 12-12, there still will be and remain liability. For lack of a better term, let's just start with January 1st, okay? January 1st to 12/31. That's your incurred date of 12 months. Okay, so the first number in this contract, that 12, talks about when the actual date of service happens, is the incurred date, okay? The second 12 in this scenario is when the claim is actually paid, when the claim gets delivered to the provider, whichever provider it is, and when that claim gets paid. So majority of claims payments do occur within 30 days. But a lot of the facility claims typically take a little bit longer because they're larger claims, et cetera, et cetera, et cetera. So in this scenario, and I will get to your specific question in a minute, but in this scenario, anything that is paid January 1st, 2019 or beyond, even though it incurred in 2018, would not be covered under this stop-loss contract. To answer your specific question, these contracts, and this one in particular, has what's called terminal liability option, okay? Basically, you can purchase additional coverage to protect the tail, so to speak, of claims that were incurred in the 12 months but fell outside of this contract period. Folks that typically buy TLO are groups that are debating whether to stay fully insured, then move to self-insured, and then have the option to basically go back fully insured, okay? If you were to go self-funded, fine with Florida Blue, the renewal contract, if we proceed with this type of 12-12 contract, we would then switch to what's called a 24-12 contract at renewal, which means it would pick up any claims that were incurred for the 2-year period, 24 being the incurred date, and then paid in that current 12-month period. So each renewal, we would just add a 12-month period onto the incurred date. Some folks also call it a paid contract. You may hear that term as well. So that's just kind of an education on the 12-12 and what the options would be for that tail. So 12-12 is not all liability all in, okay?
Thank you.
So that cost that they're looking at does not include covering that tail.
The cost here is just for a 12-12, yes, ma'am.
But if you stayed fully, I mean, self-insured, wouldn't be an issue.
The liability's there. It's just a matter of what year it lands.
Okay.
But the liability is always going to be there. But from Florida Blue's perspective, fully insured, self-funded, we just want Putnam County happy. So we're fine either way.
Since you're our current provider now, and you hired the agent who represents us, from my understanding. What would be the process if the board decided fully funded, self-funded with Florida Blue? What would be that? Here's what threw me for a loop. I'm convinced that you were accurate on that 334 number, because I know you've got our claim. So you had to hit a button to say what's their claim ratio. And it was a lot different than what we projected. Okay, the county staff did. That's what threw me for a big loop. And I don't want our committee to be blindsided by the fact that you should have looked at this based on that number. And that's why I wanted us to get back together today. But the question on the table is, you're Florida Blue. You have us now. You might have us in the future. What's the transition, either fully funded or self-funded?
So from a transitional period or process, if we move to self-funded, all members will get new ID cards because the ID card indicators are a little bit different. It will illustrate that it is a self-insured plan. The benefit booklets will be a little bit different as it relates to the actual benefits and what the members see and what they feel out when they're seeing providers. None of that will change unless you guys make any type of benefit modifications. But the benefits, the providers, all of that stays the same. Back of house, there will be the new ID cards, and there will be a couple discussions on basically establishing the banking process on how to reimburse us for claims and how to pay us for the administrative fee. It's a little bit different than fully insured. And then there will be some training for Miss Ann and her team on how to reuse the claim system, because once you're self-funded, you do have access to the claim system and have access to PHI data where you do not fully insured. So really, that's about it. It's couple weeks, maybe a month total to transition from fully insured to self-funded.
Committee members, any questions?
I do have a question, and I understand that there's 3 different options on the table here, but the projected monthly claims for those 3 different options, is it your opinion that those are actuarially sound?
The expected claims?
Yes.
Yes, all of these are accurate and even line up to what our fully insured proposal is as well, where we're on the risk. The only caveat to this, and I don't want to even mention it as a caveat, but the 1212, I'm trying to explain that that's not the full liability.
Sure, I understand.
Okay, but the number as it is presented here is 100% accurate, and we're on the risk for this reinsurance proposal. So yes, I mean, we're very comfortable with what we have here.
Okay, I just wanted to clarify that
Yes,
for all
sir.
the committee members.
Yes, sir.
Mr. Center, you had a question?
Given our current rate of employee, we have, what, 538 employees targeted here? How much, with fully insured, if we lose like 20 to 25 employees, that 3% rate changes that we were gonna get. What happens with fully funded? If we lose 50 employees out of the plan, what happens?
So both proposals do have a enrollment shift up or down change in them. I've been with Florida Blue almost 18 years. I've yet to see us re-rate a group. So I would just put that out there.
This is Putnam County.
I understand. I'm saying
if it's gonna happen, it's gonna happen
well,
to us.
The contingency is definitely there, and it's definitely there for both fully insured and self-funded. So if you're thinking about making a decision based on the enrollment shift, it's in there for both
Well, how much does it shift? Does it shift differently for fully funded versus self-insured? I mean, we didn't get any numbers that if we lost this many members, I mean, we're facing a budget issue this year where we could conceivably have something happen that allowed us not to have the same numbers we have right now.
Right. So, and the reason I apologize that I'm looking, because it's kind of standard generic language, so I'm just having to refer back to it. In the stop loss, it is 10% up or down. And if you bear with me one moment, I can find what the number is for fully insured.
Well, my question really goes
yes,
to,
please.
If we're fully insured, I'm guessing that if we lose members, our rate's going to go up because there'll be less participation. But with self-insured, if we lose members, does it typically go up or down? If it were to shift.
Again, in my close to 18 years, I've never seen one re-rated. Okay. So I don't have any experience to answer that question.
Okay.
There is a 75% participation threshold and fully funded,
Mhm.
65% in self-funded.
And the demographics and fully insured, this says 5%, which is the bullet, 2 bullets below that on fully insured, and it's 10% on self-funded. But I just, again, in 18 years, I haven't seen us re-rate one, so.
All right.
Mr. Chairman, excuse me, down here.
Oh, there you are.
I know I'm not part of the committee, but
No, please.
if I might ask one question as the county attorney, given this is a good opportunity. Part of the reason why this committee was having some heartburn is because we had, the county provided projected monthly claims data, and Florida Blue provided in their response what I believe I'm hearing is actual monthly claim data. And my question to you is, if the Board of County Commissioners chooses to go with Florida Blue, fully funded or self-funded, is Florida Blue committed to agreeing in the contract to provide detailed claims data to the county as it might be requested at any time?
So we did. We provided 3 years of data. We provided high-cost claim data. All of that was available for the RFP. We provide claims.
Well, what we weren't getting is detailed claims data, and that's what was being requested.
So depending on your access in terms of fully insured, we cannot release PHI data. If you were to go self-funded and the board signed off to have Ms. Ann or other representatives have access to the PHI data, then they could. But fully insured, no fully insured customer gets access to PHI data.
Thank you.
Yes, sir.
But self-funders do?
It comes with a sign-off. So in this scenario, the board or you as the chair would sign basically the administrative services agreement, and within the agreement there is a subsection basically would say, and I'm not picking on Miss Ann, but that's her and Marjorie is in that department. Miss Ann would have access, Marjorie would have access, but nobody else at the county would have access. There is a subsection within the agreement that would afford that opportunity, and then once that is signed and executed, we set it up within the system, and then it's available. And what that access basically will provide is taking the summary level high dollar claim reports as an example that we provide today, and it will provide a much more detailed level all the way down to the specific member name, condition, et cetera, et cetera, et cetera. It'll actually go to the claim level line, the claim line level versus a summary level on fully insured, which you can't have because of PHI. Okay. So it's a lot more access, but a lot more responsibility that comes with that.
I understand.
Mr. Chairman?
Yes, sir, please.
Bob had a good point, because I feel like after October, between October and probably February, I anticipate the clerk's office losing 5 or 6 employees, because they're not going to be able to afford to pay for their family's insurance. We've got a lot of mothers, single mothers that are have children, and a lot of them carry that part of the insurance. So I anticipate, and I think that was a good question, Bob. I anticipate us losing some. I think the sheriff's office anticipating losing quite a few employees. I don't mean to speak for you, Sheriff, but I hear that. You just get to a point where it's not affordable to work. You got to find something else. I don't know where they're gonna find it, but I'd like to bring this point back up, and this might be the wrong time for this. Just saying it's the wrong time. But 4 or 5 years ago, we looked at that. I brought this up at a meeting a while back. Tim wasn't here, and I was sitting in for him. And that was the time for us to go self-insured. Now, would it have worked or would it not? We don't know, because we didn't go. But we had $1 million, 2 or 3 in the insurance fund. That was a pretty good basis to start with. You know, have 2 or 3 good months and you're getting ahead. But you're gambling. Heard, read this thing, you're gambling, but it's still, but it was worth the gamble at that point. That window was, it was closing quickly, and the administration at the time or the commissioners really didn't have an appetite to do that. And so we stayed with Florida Blue. I'll be honest with you, that's a pretty big risk right now, where we're at right now to go self-insured, just speaking for.
Mr. Downs, I do appreciate that, and you're right. Under our fully funded plans, currently we should see savings. We went out for bid and we're going to see savings. If we add another product with a named prescription plan, we could see additional cost. So it's whether the employees go with that additional one, is it going to cost the county more money at that point?
Right. And let me just say this.
Right.
I don't mean to be throwing
No.
a wrench in
No, you're fine.
in the machine at this point, but I certainly appreciate this committee, how much time and effort and work they put in, because it used to be we'd meet at 2 o'clock and by 2:30 we were through, because this is what we got and this meeting's over. And I pushed hard against that, and the county did a study, and so we're at this point. Unfortunately, our economy is so bad, as we all know, and so now we're here. So.
Okay. Any other, Ann, you want?
I have two questions. First of all, talking about losing employees, are you talking about layoff or employees that would be, the positions would be filled again possibly? Just loss for coverages?
I'm not going to say we'll never lay employees off, but through the entire downturn in the economy, we were the only clerk's office in all the counties around us who did not lay people off, who did not cut hours and that kind of thing. Now, as people left, we didn't fill jobs. We worked hard to cover those, but we're pretty dedicated to our employees as they're dedicated to us, and we try to make that work, and it worked for us. And that's a bad thing when the economy's going south anyway, and you go in, you tell 5 ladies that got 3 children out there and they're going to school, don't come to work Monday. We don't need. We don't operate that way.
Okay. I just wanted to make sure that wasn't a layoff situation. If people leave, you're still going to be able to fill those positions, and for the reason of the coverage, they would be replaced in somebody new offering the coverages. So yeah. I don't think that would count in that effect.
Well, that's contingent on employees not having to work to pay for insurance.
Correct. I understand that.
And earn a decent living wage.
I understand that. My other question was for Mr. Carroll. In our evaluation team, we had a question that was posed about your opening letter. You talked about a wellness benefit, but it really didn't say if it was an all or nothing. Is that just for the health insurance, or did that mean we had to take all of your coverages that you offered? It wasn't really clear in that opening letter.
Sorry for the miscommunication on that. I'm pulling the letter right now just to make
That's
sure
okay.
that.
We wanted to know.
Yeah, absolutely. So it is the 4th bullet in the cover letter down in the summary part where it says a wellness contribution of $50,000 upon renewal, and that is medical only.
Okay.
So it is not required on the dental, the vision, or the life.
And I have another question, which, you know, if we enter into renewal, everyone knows here that the agenda for tomorrow has an award for health insurance on the fully insured. We were in a pro-share agreement. Did that stop because we went out to bid, or do we start over, or will that continue on?
So it all depends. If you renew with us, there is an additional 2-year pro-share, which is the 5th bullet. So the current pro-share agreement ends September 30th of 2017. We do have 3 months of run-out contractually that basically picks up the tail or the run-out claims as we discussed, and then any settlement would occur. If you renew fully insured for 10/1/17, we start a new 2-year pro-share agreement, same terms that we have today. If you go self-funded pro-share, that's a fully insured operator.
So what I'm hearing is if we do renew with you, the last 2 years under our agreement, we would still be awarded that pro share amount if there is any.
Oh, of course,
like we
yes,
have
ma'am.
in the past, only if we renew. If we weren't with Florida Blue and it's time to pay it out, I think it's January, February. If we weren't renewing, then we would lose any of the pro share. Is that correct?
Correct, and that's in the contract. Yes, ma'am.
Okay, just wanted to bring those 2 points up. Thank you.
But again, it's not for self-funded. It's only for fully insured.
Let me just clarify that statement just for the record. So if the county were to renew self-funded, there would be no need for a new pro-share agreement.
Right.
But that would not preclude you from receiving any of the surplus of the current arrangement, which ends at renewal this year.
All right.
Yeah.
Mr. Carroll, thank you.
My
Anybody
pleasure.
else on the committee?
Let me make sure I understand it right. So the surplus is carried forward if we self-insure at this point?
So
Florida Blue.
it is the current agreement ends September 30th of 17. So basically this September it ends, okay? Currently it's a 2-year agreement. Year 1, which was 10/1/15 through 9/30/16, and then 10/1/16 through 9/30/17. So that's the second years, which we're about to finish, okay? If you renew, then any surpluses, we split 50-50 like we have done in the past. Moving forward, 10/1/17, if you stay fully insured, then we enter into a new 2-year pro-share agreement. If you start self-funded, then pro-share is not a self-funded tool. It's a fully insured contract. It's not a self-funded contract.
And that dollar amount, do you know it?
We're right in the middle of the second year, so I have no idea. The projections based on what as you could see with our fully insured renewal, look very, very favoring.
We discussed it before, the projected amount, and I can't remember what it was. Do any of you?
I have a point of clarification
Please.
to ask. So either way, if we go with Florida Blue, whether it's self-insured or fully insured, if there's a positive pro-share in January, February timeframe, we'll get it.
Right.
Yes, ma'am, that's correct.
But there will be no need for it under self-funding because you
Right.
take your cost containment in-house. So that's why there's no need for it. Is that right, Mr. Carroll?
Going forward?
Going forward, that is
Right.
correct. It is a fully insured
Okay.
contract, not a self-funded contract. That is correct.
Okay. All right. Any other questions from anybody? All right. Thank you, Mr. Carroll.
My
for
pleasure.
coming
Thank
in.
you all very much.
We'll bring in the next person, United Health. Will you take that down, Ms. Papel? That can be rolled up and put away.
Just point of clarification, will you be bringing everybody back in after everybody's discussion?
That's up to you.
Sure. Why not?
Well, I'm just asking, should I stay or should I go?
No, you got to go.
No, I know, go from here,
Oh,
but
from here.
overall, will you be bringing everyone back in today?
We'll bring them all back in.
Okay, thank you.
We're going to go pretty quickly because thank you.
Mr. Chairman, is that, that sheet that was taken down, is that going to be used for other?
No.
Okay, so that could be provided to the clerk?
Yes, it can.
Mr. Chairman,
Specifically.
can we just have a brief discussion without the next insurer coming in?
Sure.
So,
No.
No.
Further discussions would need to be, and when it's back open to the public.
okay.
The closed sessions are just for question and answers of the individual carriers. Sorry.
That's all right.
Thank you. This is new territory, so thank you very much. Okay. United would be the next one. Is one of these computers rebooting up here all the time? Because I'm
It's
hearing
the
something.
AED
Oh, it's actually the
machine.
AED, and I'm actually trying to confirm if it's one we maintain or the EOC
Oh.
maintains.
The defibrillator is rebooting itself?
No, it's actually just an indication that it needs maintenance. The battery probably needs to be checked.
Okay. Keep hearing. Well, I didn't at first, so
I pointed it out. It
These
becomes your
ears.
best friend chirping in the background. It's still active in the event we need the AED, however.
So if somebody falls out, it's still
Yes.
workable unit?
It's still working. It's
Okay,
just
so
an
we can
indicating light
Test
telling
it on
us.
Commissioner Goddard if we want.
Oh, no, I was having a lot of chest pains.
Stop, stop, stop.
I think it was heartburn.
Yesterday you were home.
I know.
It's kind of scary walking down the hallway in front of all of us, isn't it?
I know, doing
We don't
the-
mean it to be, so. You can put all your stuff right there on the counter if you want, and, yep, you'll have to
Yes,
come up
please.
and grab that and introduce yourselves, and we have a few questions that we'd like to talk to you about. If you will, state your name again.
Robin Stearns.
Hi, everybody. Bill Abrahams, United Healthcare.
Okay. The question that we're looking at today is self-funding. And to give you an idea of what, and I need clarification from you on what your estimated projection of your annual claims would be, and how accurate are they, actuarially accurate are they, and divide that to give me a monthly figure. Because I want to know the hard cost before we put a self-insurance plan in effect. What would be the hard monthly cost and the reserve cost that your actuaries have decided would be the proper number?
Okay, hi, thank you. First off, I want to appreciate that we're here talking to y'all. And what I'm referring to is what was submitted in the proposal several weeks ago, and you since have evaluation meetings on that. And first off, I want to get on the record is when we respond to an RFP, we go pretty much down the road of what those specifications stated and dictated in the RFP. And what we saw, in our opinion, led us to believe that fully insured, since that was your current funding methodology, that was going to be the leading methodology, and the self-funded methodology would be provided. It wasn't our lead, you know. So my point of saying that is the proposal you have in my estimation can be improved if you allow it. It's okay if you don't, but it's not something that we've had focused on as much as we did for fully insured. And if we were allowed to do so, you know, I saw several avenues that could be trimmed, negotiated, however you want to put the terminology. But that's how we work in the business, because we have to lead with one funding or another. It's how you get the best foot forward. That was what with fully insured. ASO, you're pretty much getting 1.0. You know, you're getting, you know, the base, you know, format as it is. That being said, I'll be more than happy to answer your question as far as the claims piece, because you understand how self-funding works. You have a fixed cost component. I don't know how in depth you got in the prior, you know, iteration of the other carrier that was here, or that you understand the self-funding concept, but it's just pure claims as you're talking about. We offered up an expected factor of $730.54 PEPM, multiply that by 532, and that's pretty much what is in your proposal that we provided to you about a month ago. And that would be your expected number. That number is what we deem is close to what you would be for a fully insured quote. You still have to add in your fixed costs, your administrative costs, which are also in the proposal provided. The total liability that we saw is $5,829,739. That is with, for an expected or a stop loss number of 200,000. You would still have to add in an administration charge of $64.01 times 532. You would still have to add in a stop loss number of $70.80 times 532. And you'd still have to add in an aggregate number of $5.46 times 532. You have to add all of those numbers up to come up with your total monthly liability. But how it works is, in self-funded is, you're paying the fixed charges and you're paying claims as they flow.
Right. Have you, could they have, no, they can't get a copy of this sheet. The reason,
I mean, you're looking for me to boil down what would be a
monthly hard
like a
cost.
fully insured rate number?
I want a monthly hard cost on self-funding, and then I want your projection for the reserves that need to be put up on a monthly basis to handle expected claims.
Well, you know, quite frankly, sir, I mean, we tell you what, based upon claims given to us and how we do a projection based on the claims that you have performed based on the time period provided to us, we provide you with those numbers. And typically how we work is, it is up to you how you want to fund the numbers from a contribution base from your employees and so forth like that. I just, you know, stipulated what the total number was, you know, on that. We haven't boiled it down into a fully insured equivalent number. That was a fully insured proposal. If that's what you're asking for, you're asking like boiled down rates for our employees.
Am I able to share with them at least their rate?
Are you referring to their page that I provided in the attachment with the rates? I think what we're trying to do is compare each bidder's response one by one, and that's why the RFP was written in the way it was, so we would have a comparison and gave you the plan designs, the three that we were hopeful, our buy-up plan, our low plan, and the mid-range plan. So that's what we were hoping to be able to make a comparison from each vendor's response, but your response is a little different than the others that we see.
Okay, I apologize. Bill's going to do some calculation. I think this just threw us a little bit off because we're typically used to working with a consultant who actually guides you through this process. And we're not really clear on the consultant situation anyway, but we'll do some math for you.
Thank you.
You're welcome.
Ms. Papel just got validated. That's one of the things we've been really concerned about is the moving along too quickly with the self-funded and not knowing what we don't know yet, and how quickly we could do a turnaround on this type of RFP and have it in place by 10/1, realistically, if
Ms.
it was
Allen,
doable or not.
Ms. Papel was not unvalidated. Okay.
She was just validated again.
All those few words, validated, vindicated.
Whatever. It's questions that we need to ask.
Yes.
Yes, absolutely. And a decision like this doesn't come lightly, and you really have to have someone who's guiding you through this, like a consultant.
One of the things we couldn't find on there is if you had an agent of record along with yours.
Yes, we do. We are leading with Danny Page, Danny Page Insurance, who recently wrote a few other large groups with United Healthcare, including your Putnam schools.
Okay, thank you.
You're welcome.
Robin,
Yes.
while Bill's figuring that out, let me get this straight. On the page though that we can talk about, the 530.94, your expected claims PSPN, times that by 32. That's monthly figure, correct?
Correct.
And if I did my math right, that's $388,647.28. Is that right?
I would have to double check.
Well, I'm gonna do it one more time.
Okay, let me get my calculator.
But I guess that's the question on the table too, is that an accurate number? Actually sound, yeah, I'm getting it twice, so.
Yes, typically when we show our numbers, we're showing you expected and a maximum. What you're looking at is expected.
Okay. Because see, I had a different number plugged in, so I apologize.
That's
when I
okay.
was doing, I trying to make heads or tails as much as I could, and
we
that's
like
why
to
y'all
make
are
this
back
as
today.
confusing as possible. We understand.
Yeah,
Insurance is very confusing. Here we go.
Bill is coming to the finish line.
Okay, this is a total number based on administration that we quoted again in the proposal. You heard me here on the record that we can improve that administrative number should we be allowed. But I'm going to go with what was proposed. In addition to the stop loss fees that were quoted, in addition to the claims piece that was quoted. And what I did, just so for the edification, I made sure it was a mature number. I want you all to be careful when you start talking to carriers about, self-funded numbers they're throwing around. You have contracts that are called 1212, 1215, things of that nature. Those, by very nature, are what is incurred and paid in a certain time period. And that's very important, especially if you're running on a calendar year basis with your contract and you got a claim that comes in 3 days before the next contract kicks in. The way we work as United, we issue a 1212 quote. You are automatically reverted at new renewal to a paid contract. And that protects against any gap situations. We have a claim, for example, if you're 1-1, claim comes in on December 30th, had too much fun on New Year's, things come in, in a couple weeks later, maybe a month later, you want to make sure you're protected in that gap situation because you just hit a new contract come January. So when I quote matured number, thinking you have some run out or what is called a tail, that you have your 12 months of accrual, you have a few months after that so you can wrap in a totality, what you consider a mature quote for a group of your size. That said, I've got a number of $6,444,038. I would say that's roughly, but I'm very confident in that number. Should this become something we talk about more concretely, we'll go over those numbers with you again, but that's based upon what I just did. I matured your quote. Yes, ma'am?
Can I ask my question?
You may.
Okay. 1212 mature, that's tail
That's
included
immature.
Or not tail included?
1212 is an immature number.
Okay, so
what I just did is I matured that 1212 number by the immaturity factor.
So say we have a bad year, first year going out. And
That's not your maximum. That's your expected number.
That's our expected,
right.
but all of our claims are higher than expected, but under stop loss.
Mm-hmm.
So we've got a big number, and we go, we don't like this self-insurance stuff. We want to go back to full insurance. That includes the tail, the number you just gave us.
That number does not include the tail?
Does not include the tail. Okay.
And I'm about to give you that number, and what you're asking for is an absolute worst-case scenario, which, understand in the self-funded world, folks, when we say expected number, that's in akin to what a fully insured number would be. Your maximum in a self-funded world, you're paying a little bit more insurance because you're taking the risk for your claims, but if you're going to offer us up as a stop-loss carrier to say, hey, you got to burden some of the other risk, we need a little aggregate number added in there, or you want the aggregate number added in there to lower your premiums, because if the lower that aggregate number becomes, you might as well buy a full insured rate. And you're just offloading the fully insured risk back onto the carrier, which is what y'all been doing for a number of years. So that particular number,
All right, committee members, any other questions?
Almost.
Waiting on his number.
Bill and Robin?
I'm checking the math of what the underwriters are doing, so bear with me, guys. $7,272,840. That's your all-in worst-case scenario where you had a worse year than you're running now. I understand that you're running pretty decently right now. This would be a lot worse than what you've been doing. That is your absolute 100% all-in number in a self-funded world.
What were the last three digits?
I'll repeat the whole thing again just so it's clear. $7,272,840.
All right. Thank you. Any other questions? All right. Thank you very much. We appreciate your time. Melissa. The next one will be Aetna. Okay. If you will, come to the microphone and state your name for the record, and we will get started with some questions that we have. Please.
Colby Jackson with Aetna.
I'm sorry?
Colby Jackson with Aetna. Sorry about that.
No, that's okay, Mr. Jackson.
Mike Driscoll, Aetna. Afternoon.
Good. Mike Driscoll?
Yep.
Thank you, Mr. Driscoll. The questions we are at right now, would you give that to the clerk? Yeah. The question is, this committee came back together to look at self-funding and look at some of the numbers that were in self-funding. On our sheet up here, and I can't share a whole lot of information, but it seems like we were given, what we want to know from you basically is this. What is the monthly hard cost of the self-funding option 1 plan that you have with the $150,000 stop loss? What is the monthly hard cost? And I could not find, or we could not find your estimated claims on a monthly basis. So the 12-month estimated claims divided by 12, what would that be? And that's going to give us some idea. And I guess the third question is, how actuarially sound would that number that you're going to give us be on the expected claims? Did that help you, Mr. Driscoll?
It does. Can you all hear me okay?
Yes.
Okay, there's a few things I want to look through. Here we go. I have a quick answer for you, but I want to look a little deeper for something. Because I think my impression, do you want me to tell you, so I had a history teacher who used to say, tell me as much as you know, not as little as you know. Do you guys just want the straight up answer, or do you want my history teachers?
We don't want to know how they build the tire.
That's fine.
Okay.
Do you want to know how many treads are on it, or you just want the cost?
Good. That would be good.
I'll tell you maybe a little extra. So, first year fee, $13.90 times 532 times 12. That's our fixed cost. And I can get my handy dandy
That's the right number that's in our sheet
Okay.
up here, so that's good.
There's a slight escalator on year 2 and year 3. I could also, if you were to look at that year 2 number, that in general tends to be, if I were to say you want a 3-year fixed cost, it would be pretty much within 2 cents of that $15.05.
Okay.
If you wanted to spread that over 3 years.
So the administrative fee for 532 employees would be $88,737.60 a year.
I didn't do the math yet, but yeah, that sounds about right.
Okay. Now, the only other number we have is the composite rate per employee covered. And I guess those two numbers will give us a fixed cost.
A composite rate.
Per employee covered, yeah.
And where are you seeing that? For the fixed cost, that should be all there is. Yeah, I'll look to the table to the left, I guess. And
The $3.50 PEPM?
Okay.
Is that what you're talking about?
Where does the number right underneath $1 million come from?
Under option 1, or all of the options have the million
Yes.
maximum annual reimbursement? Is that what you're talking about?
The number below that.
Am I able to give the number that's their number or not? No?
If it's, yes, if it's from their bid, certainly.
Well, I'm assuming
Not
it's
sure
from,
what it is, I can't.
it's from our spreadsheet. The 45,172.12.
Yes.
Okay.
Yes, thank you.
So that's safe to say that that's 45,172.12 plus the 7394.80 would give us a monthly hard cost, correct?
I'm not sure where you're taking the number from, sir. I'm sorry. That second number.
Okay. She's gonna.
I've got your sheets here. Let me see.
Okay.
Is it the ISL cost? Is it the stop loss premium?
Perhaps. What's the stop loss divided by 12?
Mr. Driscoll, that's why we're having this meeting today, because we need to get to the bottom
Yeah.
of all these questions.
Well, I think part of the issue is we don't actually have the projected monthly claims from Aetna, and that's what we're interested in.
Right.
It's,
Oh,
that was from your bid packet.
okay. So the stop loss ag would be 5.3 at a 1.2 corridor. You would tend to. So. Yeah. This last page. Yeah, it's the same thing I was looking at. Okay. Looking at the illustrative stop loss quote at 125% corridor, so our number for an expected number was 5.345. That's at 125%. So
Do you divide that by 12?
I will. First, I want to get to a.
Okay.
So the expected, to your question, the expected would be about 4.2 million of claims. Is that around the same number you're getting from everybody?
Well, I don't know that. We're not going to go there. So you're looking at 4.
And then you would divide that by 12 for a monthly expected.
So
claims.
about 350,000 a month would be the expected claims based on $4.2 million in expected annual claims, correct?
Yeah, 355. Yeah, that's the number I have for expected claims. But I wouldn't take that number and do much with it if I were you guys, because that's an expected from the carrier. So I would be very hesitant to use that for me.
Would you please?
Or anyone.
Right.
Other than the fact that the attachment factor is 125%. So
I understand. This is the shot in the dark, which you expected claims. It's not an actuarially sound number.
no, that I disagree with 100%. It is an actuarial sound number.
That's how you got it.
Yeah, I mean, we use there's a lot of actuarial work that goes into a number like that.
Go ahead. We need to be educated.
Okay, all right. So if I were to step back on this whole thing, I would say the consultant that you're, from what I understand, currently paying.
We don't pay anybody.
You do. You absolutely do pay someone. You're within your Blue Cross rates.
Well,
it's your money. If you were to take that money out, it would go directly to you. It would decrease the number. And so if I were to look at the process and some of the questions being asked of me right now, I would share kind of my experiences. I'm dedicated to public sector, so that's all I work with. I was at a board meeting last week, get questions like this a lot. I think that expected number is really important, but I would be looking at it kind of with network discount guarantees attached to that. I would look at the base. You're fully insured currently?
Yes.
Yeah. So there's, you know, I would probably want to step back and say, okay, we know our max risk, which is that 5.3 number. I've seen once in my 20-year history of the business anybody ever hitting that number. So that 5.3, which is our expected claims of 4.6 multiplied by 125%, you could also come back to us or any of the others and say, lower that 125 to 120. You could tell them to lower it to 115 as a negotiating point. So if you're interested in self-insurance, which will save you money off of taxes out of the gate, I would guarantee if you moved to a self-insured arrangement, I'd be willing to put up my own personal money that you will save money out of the gate. What I think you just have to have a tolerance for is what your risk is, which is where you look at that expected and the attachment, and then you should be looking at network discount guarantees and medical management guarantees. So I'll stop there because I don't want to go too far afield.
Well, that was my next question, was what kind of the cost containments are inside that? And naturally, what you just said, the more cost containment features, the lower premium or the lower the risk is at that point, or the maximum potential claims.
How you define cost containment picture would weigh into that. When I describe, say, medical management, I would put our approach to medical management up against any of my competitors. However, that's my company, so of course I'm going to kind of, drink my own Kool-Aid to some degree. As a general rule, I don't consider cost containment as we change the benefit design. That's risk transfer. You're taking some of the money of the county and saying, employees, you get more of it. But that your total cost of that 4.6 or that 5.3 really should remain relatively the same based on benefit changes. What you could change with that risk share is behavior, but then you get into true medical management, disease management, wellness implementation. What my proposal, now I'm going to do a little selling, so I'm trying to find the balance of I get an opportunity in front of you guys versus what we do is we're putting a network discount guarantee as well as kind of a medical management, and that's rare to see both of those together. So we're putting a lot of performance guarantees in terms of our confidence in being able to manage the business. When my actuaries assign a value of taking over a case from Blue Cross, we put about 0.96 on the medical management, meaning if they spent $1 million and networks are equal, we would spend $960,000.
Right.
So that's it all kind of goes in, and I don't think you can look at one lever without looking at the others. But I would encourage you that if you're going to go to self-insurance, to look at, based on your risk tolerance, look at that max number, have a fair confidence level that it's never going to hit that. And that's why you have aggregate stop loss, and that premium tends to be cheap. The number you could tweak a lot more is the individual stop loss number, which means if any one of you individuals went over a certain amount in claims, that's a premium you could reduce a lot more effectively. I don't think the ag stop loss was probably all that expensive. That's my guess. Yeah. Sorry, I don't want to go too far afield again. Are there more direct questions?
When I did the math, sitting here, and I added the 350 expected claims
to the fixed
7394.80 for the this is monthly cost, and the 45,172.12. That brought me to 402,466.92 times 12 is about $4.8 million a year. And that's what I looked at.
That $400,000 number is really 445,417.
I'm sorry?
That $400,000.
You gotta be,
Yeah, you got to do that.
That 400 and some odd $1,000 number, you guys rounded in the $1 million, and then divided out. Unrounded, it's 445,417.
It's just a lot lesser number than what's on our paper here. A lot lesser number.
I just did some quick math with the numbers you provided, and that came out to a loss ratio of about 87.5%, which for a fully insured case would be a high loss ratio, but in a self-insured case, because you have savings on taxes and the like, is a pretty reasonable loss ratio. So that number makes sense to me in terms of a relation of fixed cost to claims cost. I know, and I apologize. Sometimes I'm going to speak insurance.
You did fine.
Yeah.
You're fine. You're fine. Committee members, any questions for Mr. Driscoll, Mr. Jackson?
The per employee amount, did we get that figure? Did anybody drill down on that?
That's a great question.
Yeah.
Ours is probably lower.
I'd like to know what it is.
Well, it's 13. It's like over 3 years, it's about $15 PPM. I think it's really important to point out that based on that number, I'm quite confident in saying this, that that keeps the rebates with us, the pharmacy rebates. And right now, you don't get pharmacy rebates. That's another advantage of being in a self-insured standpoint, is that those dollars can pass through. So if you're having a lot of pharmacy rebates is not necessarily a good thing. You know, you get better coupons off the brand names, but it is an important part of any analysis of a case your size. And I would strongly encourage you to kind of look at what is the expected pharmacy rebate. And if you were going to go to a self-insured situation now, I would ask for what is your guaranteed pharmacy rebate amount, and then ask for a self-insured PEPM cost that does not take into account pharmacy rebates offsetting it. I'm taking a lot of pharmacy dollars and I'm applying it against my fee. Right. Now, that's a good thing. That's something that it helps you guys, but you should have in writing that dollar amount so that you know if 25 to 35% of your spend is on drugs, let's make sure we know that you're going to get full credit for the rebates that may come back on some of those drugs that I'm using to offset my fees.
One final quick, Mr. Lible.
I had one more.
Yes,
and
sir.
You coupled two things together a minute ago, the network medical management,
Yep.
your firm does, and
Yep.
wellness something. What was, and this ties into that pharmaceutical you're talking about, the wellness clinic. What effort, can you clarify more of what you're doing there? So we don't have a wellness plan. Right,
yeah, and that's not uncommon.
Well, we have a health fair, but it doesn't accommodate.
We
Right.
don't have one.
Right, we don't have one.
So, I don't want to hurt myself here, but I don't want to over advantage myself either in a way that I lose any credibility. To answer your question, I would say the wellness program that we would put in place is going to feel like anything you have now on steroids, but we're always going to be flexible in how we work with you. We're not going to say, okay, everybody needs to do this, go on a 5K run. We don't want to pay runners to run. You know, that's a wellness program from 10 years ago. But in your current situation, the strength that you have with Blue Cross tends to be they have a stronger network in rural areas, which is where I would look at the network discount guarantee and compare ours to theirs. We've done a lot of work. We just won a case in a more rural area in Central Florida last week because we've done a lot of network work. That gap has closed, but ultimately that is going to be the biggest driver in anything on your claims costs. So if you ultimately decide that the pharmacy is fair because you asked for the details that I just described, I wouldn't focus as much on that PEPM cost on the admin fees. As long as it's kind of close, I would look very much at the network discount. And if we're at, I'm just making up numbers, I can't look through right now. If we're at 55% and Blue Cross is at 65%, renew with Blue Cross and be done with this. If it's 55 to 53, then you really want to look at everything a lot closer. So to the wellness point, let me get to.
You shifted gears on me.
I did, and I'm sorry because it's so connected. I apologize, guys.
That's all right. It was still valuable.
Including. Enhanced clinical review, yep. Yeah, so we would, from a wellness program, you know, you have a lot of online tools. We're going to be offering a 50 to $100, you know, $50 incentive for everyone to do biometric screenings and the like. We had an optional cost for a healthy lifestyle coaching at $2.20. I wouldn't encourage that out of the gate because I think you got to ease into it. But the tools are going to be there, and then it's more about building a strategy of engagement. I would lean heavily on the consultant to help with that. And maybe if I could just offer the kind of unsolicited, which is I rarely see anymore, we're attached to one of the consultants, and we were going to bring them, but we thought it was vendors only, so we apologize. But we attached ourselves to the Bailey Group for this, which is a pretty decent-sized firm over in Flagler. I know that Bates, in St. John, sorry, Bates currently works with you, and Page is working with United. Hunt, I think, they're kind of on their own as well as a TPA. If you guys are thinking of kicking the can for a year, I would do a lot of my effort on choosing the consultant that you feel is going to fairly assess and analyze a lot of the questions that you guys are asking, so you can have, I think, an opportunity to really tie these different things that I'm bringing up together. All these people know what know what they're doing. I think the question we always have is one of fairness, and we would encourage you to bring in ourselves, United, Blue Cross, during the course of the year to really get a sense of, to your question, what will you do for wellness? What will you do for this? So that you can see our theories and philosophies versus theirs. I'll tell you, there's some things we do that I think are unique and better. I'm a former United guy. I think there's some things that they do really well. I think there's some advantages to Blue Cross. It's what's the right fit for you guys, and is the price fair? And the consultant should drive some of that. Sorry, that was a little unsolicited, but I would encourage you to kind of step back on that.
I was looking for a step further, that you corral the actual members into a cheaper route to ensure this wellness, not just rely on a fare?
I think that
or
that's
a supercharged one from the consultant?
No, I think that that is a very reasonable approach. I mean, in my own health program at work, that's what they do to us. They incent us, they kind of corral us, but they can never force us. And I think unless it has the endorsement, and I would say this, so I used to sit on the consulting side of this. I used to say to every member of this room, if y'all aren't going to engage and participate, if you expect everyone in uniform to go do these things, but you won't do it, it just never flies. So to quote unquote corral them, if there's not leadership engagement and management engagement, is a waste of time and money. Then you just focus on the network and focus on the prescription rebates and the admin cost.
Do those three again.
Network? The network. And again, network should always kind of lead the conversation. I think that the network in this situation is all pretty. We were just awarded the state of Florida business for Nassau down to Volusia. Now, I know that's not here, but I mean, that's I think an example of something that is new and different, and the network work we've done.
You did network, prescription rebates, and
the fee itself, the admin fee itself, and what's included in that fee. If I'm including a wellness program at $100,000 plus the $50 incentive, which I'll do, we sometimes, I wouldn't do it, I wouldn't recommend it rather, but we will include individuals who work for Aetna to be on site full-time at the county. I wouldn't recommend it for you guys. I think you'd want to ease into that. But I think that's a strategy that a lot of your brethren across the state are taking more and more. On-site.
You have to.
Well, because ultimately you need someone to dot the I's and cross the T's to make these things work effectively. And I think your point around corralling the folks, you know, whether it's stick or carrot, you got to work with your culture. But ultimately, the only way you can drive costs down at this point is if people are engaged. And if they're just using the network, you're not gonna get engagement.
Thank you, Ms. Papel.
What you're quoting here is 1212 insurance, correct? So if we went in and decided to go self-insured and had higher costs than anticipated and decided to bail at the end of the first year, we'd have a lingering liability, correct?
You would. Yeah, you can buy terminal liability, you can buy 1218. There's options to mitigate that.
But it's not included in the cost.
It's not in this,
no. Tail.
Yeah.
No.
So there would be a tail.
Yes, but we can make the tail go away, as could United, as could Blue Cross, as could anyone.
Right.
A lot of these are just financial vehicles to make sure that your risk tolerance is done properly. And any one of us who stands up here and says, no, this is what you want and why, never did their homework with you in the first place, and I would discount that approach. I mean, if you're telling me you're worried about a tail, then I'll tell you, a deal I just did last week was they want to look at self-insured. They weren't comfortable with it. They stayed fully insured. They made me give them a second-year hard rate cap. I don't do that a lot, but I'll do it because I understood that was their main concern on fully insured. And you don't see that much. A second, you know, I said it will not be more than 6%, period.
All right, committee, any other questions?
Ann has questions.
Ann, thank you.
Thank you. How long would it take approximately to set up the network in our area if you were considered, like next year, if we were going to go self-funded? How long would it take to establish that here?
It's here. It's turnkey. Colby, who lives right across the river, could probably speak even better.
Okay.
Network here.
Yeah. Our network's in place. There may be, like with any other carrier, when you move to another carrier, there may be one or two providers that are not in the network. But if that's the case, anytime a client moves to us and there's not a provider in the network, we will reach out to that provider and let them know what's going on, and many times the client will as well, and that'll help to expedite matters. But I can't say that our network is deficient. It's certainly set up. It's certainly been in place for a while. Now, I can tell you, and I'm going to maybe get a little personal, but I'll bring it back to business, and hopefully you guys will indulge me. I've been coming to Putnam County since the late 70s. For anybody that grew up here, You probably know Gerald Moats, Groceteria, Joey Faulkner, who had the little meat market down on Mosley. I used to deliver meat to a barbecue restaurant on Washington Street, ribs. They were only open on the weekends. So I'm familiar with Putnam County. When I first came to work with Aetna 13 years ago, you heard Mike mention the rural counties. Aetna's perspective on doing business was in the core markets, Jacksonville, Orlando, Tampa, South Florida. I pushed for a long time, and we're finally getting there, as Michael mentioned, for Aetna to look beyond the core markets in the rural markets, the Putnam counties of the world, the Hardy counties of the world, Gulf counties, Bay County, etc. That's changed in my 13 years with Aetna, and I'm glad of it. And that's one reason I think why we're here now, because historically, Aetna probably would not have taken a look at Putnam County. So I am very happy to be standing in front of you guys today. If you make a decision to stay with the Blue Cross, that's great. But one thing Mike mentioned, I think, would behoove all of you guys when you're kind of not under the gun, all of you as well, is have each carrier come in and do what we call a capabilities presentation. And that lets you know what each carrier brings to the table. That's something you can do at your leisure, if you will. But right now, I sat last week and listened to you guys, and obviously you're kind of under the gun to get things done. And when there's a lot of pressure like that, it's easier just to stay where you are, and I understand that. But I would strongly urge you to make that decision to do that sometime in the near future with every one of the carriers that's here today talking to you. That way, each carrier can show what they do best and how they distinguish themselves from their competition. I think it would be well worth your time, well worth the county's money.
Now you get a bonus if you can tell me the name of that barbecue place on Washington Street.
I have racked my brain. Matter of fact, I was going to go down Washington Street today because I loved his ribs. He was only open on Friday, Saturday, and Sunday.
Thursday, Friday, and Saturday.
Thursday, Friday, and Saturday.
He's going to tell you who it is.
Who?
It was my old driver's ed instructor, O.B. Henderson.
O.B.
It's been 40 years. It was 19.
He's passed now.
Yeah.
Oh yes, 1974.
I'll tell you how good his nerves was. When you went out in the car and he had the duplicate steering wheel and brakes, he would fall asleep.
Yeah.
He trusted you that much.
Is that right?
Remember that?
Yeah, I love those ribs. Believe me. So.
I did too. I ate there every weekend.
Okay, you know what I'm talking about that. Believe me, I had a slab of ribs every time I went there on Fridays and took them with me.
Slab of ribs and bread.
It was it. That's all you need. Thank you for your time.
He was loved by this community.
Thin end sandwich.
All right, any other questions? Mr. Jackson, Mr. Driscoll, thank you for coming. We appreciate all the insight.
You bet.
Yeah.
You bet.
All right, thank you.
Feel free to call us, any questions, and we wish you luck. It's not easy. This is not an easy decision. I think what we represent are a national company with a local understanding. And
Well, one thing you clarified for me today, that the numbers on our spreadsheet are a little different than the ones that we just talked about, quite a bit different. So that helped us out a lot.
Okay.
So,
okay. And yeah, we've seen it sometimes where we see it sometimes where if you need people to come in, tear apart the binder, look at this, how does this connect to this? I think that may help to get how network discount guarantee ties to medical management. We'll put trend guarantees on things, which gets back to your point of how do I know?
Right.
And so we are really excited about working with everybody in this room, which is why we're here today, but we also understand it's not easy. And so thanks everybody for your time.
Thank you. Thank you very much. Committee, do you need to take a break for just a moment? Are we okay?
Also had good ribs.
Who?
He knows.
Yeah, Walton. Yeah. All right, then we'll just plow right ahead here.
Oh, absolutely. Are you kidding?
Yeah, Melissa, if you'll bring in Florida Sheriff.
He was very good. I mean, that guy looks like Lester Holt. He could dub.
I left it somewhere.
You did what?
I knew I left this somewhere. I'm like,
You need to,
Yeah.
big yellow thing in my face.
it looks like he could do the evening news for us. Uncle Lester. Yes, Kenny, you're right on the money. This is at the 10,000-foot level. It's hard to follow. You don't work in this every day. Okay. Make mistakes so easy.
Need salt, guys.
Absolutely.
But
Marjorie, that was no cut on your health care. I just think we gotta go further. You do a great job of what you have to work with. You really do, let me clarify. But I think it should be mandatory. This is important stuff, and it's getting real important. It's so expensive.
What is that? That's gotta be a computer up there? Something's happened.
It's this camera keeps moving. Off the chip's head.
Anybody want water?
I would, Chip.
Okay, who else? Thanks. All good.
You don't come back to me.
There's nothing stronger.
There's root beer.
They make some good root beer these days.
Let's try it out. It's not complicated as IT.
If you'll come up and give us your name and get yourself organized, there's a few members in the back there. Mr. Davis, would you let them know back there that they're... Hang on just a minute. We're going to get everybody in.
You're fine.
Sorry. I didn't know I had to. Don't do that, Commissioner. I think the sheriff wants to be here for this one.
Yeah, that's the requirement.
Okay, if you'll give us your name, please.
Sure. My name's Tamara Volkert. I
Tamara?
represent Tamara.
Okay,
Tamara.
all right.
Last name Volkert. V as in Violet. Olkert. I represent the Florida Sheriff's Multiple Employers Trust. I am employed by Hunt Insurance Group.
All right, good. I have some questions for
Sure.
you, Tamara. You have presented a self-insured product. That's a little different than probably everybody else because you're also a pool,
Correct.
right?
Mm-hmm.
And you have a lesser stop loss. Yeah, you have a lesser stop loss proposed here. My question to you, and it has been to everyone who's come before you and who come after you, is I'm looking for the hard numbers of what the monthly cost is to do business with you, and what would the claims reserve on a monthly basis need to be put up to be actuarially sound as we can.
Part of the dilemma in such a request is the underwriters with the stop-loss carriers require claims through July.
Okay.
We're in June. Clearly, that is not something that I could guarantee until that time. As this is a pool, I am obligated to protect the best interest of all parties, not just Putnam County.
Will you bring that microphone closer?
Sure. I am
Okay.
short. I'm sorry.
That's okay.
As I was saying, it's our obligation to ensure that the pool as a whole is protected, so we don't finalize any rates until we receive July claims. I can do through June with permission from the underwriters, but I wouldn't be able to give any hard, fast, solid data until at least through June, if not July claims.
Inside your proposal, though, you have given us on your tab 4 of your rate exhibit some cost here. Would those hard costs change, or would just be the claims?
The stop loss and claims are the only things that would change.
Okay.
This is a pool that's a growing pool, So when I look at the group your size, so 532 employees, you know, if you look at roughly total belly buttons in the 1,000, maybe a little bit more, a group your size on a from fully insured to self-funded basis should not take on a high spec. I was looking at the actuarial analysis that was completed. 150,000 spec is very high. I have a 1,200 life group that is at 160. There are 1,200 employees, about 2,500 belly buttons. Okay, so employees, spouses, dependents. A group your size on the first year moving from fully insured to self-funded, in our opinion, as a broker, as an underwriter, and through our actuarial analysis, we wouldn't put you any higher than 90 at the max, maybe 100,000 in your first year. Yes, you may pay a little premium on that, but what you're moving away from is a fully insured basis where there's retention and they've got you under their own stop loss, if you will, spec levels. I don't necessarily, you know, our opinion is what we presented. And as the pool grows, so will our ability to price it better. So right now we have a few participants in the pool, sheriff's offices. Obviously, it's a sheriff's trust. And what that brings to any county that's willing to participate is the advantage of pooling your claim dollars and administrative costs with a predominantly male-based and younger population. So when we look at the pool as a whole and then each individual entity, we feel that your office should be around 90,000 specific. You will pay a little more for premium. I'm not going to lie, that's the nature of insurance. The lower the deductible, the higher the premium. So if you go for a higher deductible, that means that you will have to put that cost, that fluctuating cost, within your reserves.
So what I'm hearing is basically we would go from an unmanaged to a managed, and the comfort level for the actuary is 90,000.
Mm-hmm.
Okay.
Correct.
That then we'd be more managed for
Correct.
the first year, and after that the stop loss could go up based on how manageable we were.
Your specific deductible, correct.
Right, our
correct.
specific deductible. Okay. Okay. But right now you can't give us, I mean, in our bid, in our sheet right here, we have certain numbers that were given to us by you.
And we did include a caveat that it was not finalized until July claims.
Okay. So that would be the trigger. We would have to wait till July. Okay,
Yes.
let's just say that we hypothetically waited till July. What would the say the rates were decent, what's the transition to go from fully insured to this pool?
The transition as
Because
far
we have
as
deadlines to meet with payrolls and it just, yeah.
we have moved fully insured to self-funded clients many times. Actually, both participants in the pool moved from a fully insured to a self-funded basis, moving into the pool. We were able to transition them. You're paying right now a fully insured premium. So you give the money to the carrier, and that includes any IBNR, incurred but not reported.
Right.
So any claims incurred through September 30th will be on your fully insured contract. 10/1 and on would fall under your self-funded. So that's why, again, we proposed a 12/12. So any claims incurred in the 12-month period and paid in that 12-month, and then beyond there you move to a paid contract. Incurred in the last 24, paid in that 12. So for going from a fully insured to a self-funded basis, that transition would be if let's say it's through July, and hypothetically if I could get it through June claims, which we would have July 15th, somewhere about that. Say a decision is made towards the end of July, notification is given to the carriers, and then notification to your employees as far as when your open enrollment would be. What we've proposed is no change in plan designs. So from an ease of transition for your employees, they're already familiar with the plans. What the underlying change would be is the network and that's an exclusive network. And that has already been created in the state of Florida, and we then go specifically county by county and get enhanced discounts for that. So the transition would be notification to the carrier, notification to your employees, and then the background of getting our enrollment system up to date, which we have an online enrollment platform called Benefit Solver, which was included in the information. So we would get that up and running. That already has a feed directly to the carriers for eligibility purposes. So we would be able to conduct enrollment meetings probably mid to late August and still be able to hit ID cards in the mail before 10/1.
Commissioner Lowell, you had your microphone. Did you want to?
Yes.
Okay.
Let's start with the IBNR. Back up to that just a minute. We were referring to it as a tail.
Mm-hmm.
And so you're a 12-12, but you said something different than the others that said. Did y'all catch that?
It's incurred but not reported.
Yeah,
I know what IBNR is, but
she's saying fully insured doesn't have a tail.
Nope.
It's only the self-insured has a tail.
Okay.
Yeah, so she was giving you the fully insured would be 10/1. They would pay.
Thank you, Clay. I knew there was something different. All right.
Yeah.
The pool.
Mm-hmm.
We would go into a pool with younger, healthier people, you just said, or predominantly
Typically.
male.
Mm-hmm.
But what do you do with your seniors?
As
Still?
Florida statute requires that all government entities offer the same insurance to their active as their retirees. So retirees stay in the same bucket. And the beauty of this program is the care management, case management, disease management that this program has through Quantum Health is for any member, whether it's an active employee, COBRA employee, or retiree, and we're able to build a network wherever that person is located. So because by statute you have to continue to offer insurance to your retirees, you don't have to pay for it, but you have to offer it, we're able to still manage their care, make sure they're getting the right care at the right time at the right price for both the retiree and active employees and the plan.
That's interesting. I thought the life expectancy of a law enforcement officer might have been real short. Thank you for clarifying that. Gator, not picking on you. It did sound funny.
Question for you.
Mm-hmm.
The network. Let's say that we decide to go that route, and we all have certain doctors in this area that we like, but they're not in your network. Will you reach out to those doctors and try to build a relationship for them so we can have a network here?
Absolutely. The way the network is Prime Health Services is a global United States network. It's throughout the 50 states, so anywhere that you have somebody, whether it's a student, a retiree, an employee goes on vacation, the network is expansive. It's throughout the country. What we're doing is we're reaching out to the providers you want to see. We're not dictating to you, here's the network, these are the doctors that you can see. We're saying, you tell us who you want to see. And we're going back out and negotiating to each provider on your behalf. As it relates to the sheriffs, it's easy to do because they're a local law enforcement. They're keeping you safe, they're helping protect you. When it's the county, this is the county, you know, it's your taxpayer dollars, provide us with the best discount. And we've been able to negotiate Medicare-based rates throughout the state. We have HCA, which is one of the biggest hospital facilities in the state, has already committed to us. Were able to jump through all of their normal negotiation hoops to sign a contract. So we already have all their hospitals and physicians. Mayo Clinic actually reached out to us and said, where do we sign? We want to participate in this pool. We want to take care of the law enforcement. So it is very easy for us. What we've done in the past with the counties that have joined and are committed to join is we reach out to your office and say, who is it that you want to see? We also look at your top 25 utilized physicians and facilities to make sure that we have them in the network. We already have Shands in the network and all of their physicians. So we're able to negotiate quickly, a little bit different than the I call them BUCAs, the Blue Cross United, Humanas, Cignas, everybody that's out there, Aetnas. And I represent them all. I'm a broker. I'm not going to lie. But when you try to nominate a provider in that spectrum, it's a harder process to get those providers in the system. By using Prime Health Services, we're able to negotiate on the fly and get providers in the system. We actually have a cancer patient going to Atlanta, Georgia, and we were able to negotiate a discount with that physician within 2 weeks of her. We're notified her appointment's in 2 weeks, and we got that contract bound. So it's that ability to nominate and get those providers contracted quickly that's been very successful.
Aren't they all private?
Hmm?
You said through a private entity you can negotiate better, but they're all private.
United Healthcare is private, yes, but I want to say we're more nimble because we're not a corporation that's throughout the United States. We're not bound by the corporate logistics of a provider relations department and this department and this department. So we're working directly with Prime Health Services, which is a nationally known network, more for workers' comp and group health, which is the group health side, that we're able to negotiate quickly.
Okay.
All right, Tamara, I want to bring you back to page 18 in your exhibit right here with your hard cost in there.
Okay.
The rate exhibit, tab 4. Could you, there's a total premium, well, I'll wait till you get there. Miss Allen might have a copy that she can hand to you.
Hold on, Larry, I don't have it.
Okay.
Well, I don't think I have it.
You do under your,
Number 4.
I have it right here.
Oh, okay. It's under bid response number.
give that to Commissioner Lible real quick.
I got it.
Okay, never mind. Okay, so under here, your total premium is $5.3 million. You see that? So help me understand, the total administration is $432,000 a year, correct?
Correct.
Okay, then you got your pool aggregate that's going to be on top of that, and then your client specific. So you add all that together. What's the total stop loss fee of $1 million versus the expected claims?
The total stop loss fees are the pool aggregate plus the client specific deductible. It's fixed premium.
Okay, and you're anticipating, based on the information we provided to you or to your group, that we should have claims in and around $3.9 million.
Yes.
Okay, is that in I guess my question to you, it's July. It's the end of July, and those numbers stayed the same. Would you say that that's an actuarially sound number to deal with? I mean, that's what your pool's going to be expected to pay out.
Correct.
Okay.
The way that this program is managed through Quantum Health and the case and care management model that we have, and it's very different, and I'm going to speak to it for a minute because this is what really differentiates this model from the major carriers that are all represented here today. So we have what's called a pod, and this pod is a group of 25 individuals, and they're customer service representatives and nurses. And they're sitting side by side. And what their model is these 25 people take all phone calls from all doctors, from all members, from all spouses, from anybody calling in about this are the same 25 people. Our goal, and what they've been successful in doing, is steerage, making sure that the members are receiving the right care at the right time at the right price. And I've already said that, and I'll say it again. Part of our problem in our culture, in our society, is wastefulness. I have a friend that went through 2 CAT scans in 2 weeks. The exact same results were given both times. So the waste of her having to go through 2 CAT scans, because if you've ever been through a CAT scan, they are not fun. And the waste of our money as an employer in having to fund those too. So by having the care coordinated by the same 25 people, whether it be the provider calling, the doctor's office, the facility, or the member calling, we're going to ensure that that person is not having duplicate, I can't even say the word. Thank you. Services done, which could be harmful and certainly a waste of time, but that the providers then are able to coordinate these results. If the results of this are inconclusive and they need another test, by all means, our intent is never to prohibit getting better. We want to just try to orchestrate it better. So by this model in that care coordination, we're able to make instead of claims going up, claims are going down. We're able to control costs and make sure that services are accurate. When we were looking through your high-cost claimants, you had someone with over $300,000 worth of paid claims, but no hospitalizations, and they're all physician charges. To us, that doesn't bring light to the situation and what claims were paid. So by getting the claim detail, having the care coordination, you're able to control your costs, you're able to question services being provided, and our whole goal is to be warriors for our warriors. That's our sheriffs. By the sheriffs allowing the counties to join, then they're protecting their counties, the people that they're serving. So what we're trying to do is manage those costs, and why our claim model from an actuarial perspective is lower, because we feel that care management and case management is what is critical to really moving that claim needle, and we're not seeing it on the fully insured market.
All right, thank you. Ms. Allen, Ms. Papel, any questions?
I do have one question for you, Ms. Volkert. The one thing that's a little different with your group is your public group. And could you speak to us a little bit about the process that we wouldn't have to go out to bid if we wanted to go to your services because you've already bid your pool? Could you explain that a little bit to our committee, please?
Sure,
Thanks.
sure. The funds are held in trust, and because the trust isn't technically government employee or a government fund, we are able to offset the need or requirements to go out to market, and the pool itself goes out to market on your behalf. So whenever we look for stop-loss vendors, we are going to A-rated or better, and we're going out to not a formal RFP like you would in the public sector, but on behalf of a private.
So you've already bid that through the Florida Sheriff's bidding process, and as a county, we're able to join in through that.
The sheriffs have allowed, yes, the Board of Trustees of the Florida Sheriff Multiple Employers Trust, correct.
Okay. Committee members, any other questions? All right, Tamara, thank you for coming down and going over that with us.
Vicki would have been here. I think you met her before, but she was not feeling well. So.
That's okay. Thank you. All right, committee, we have one more left, and then we'll call it a day.
What's that?
I don't know.
That's what they're only calling. Oh, yeah. It doesn't matter.
Do what?
It's estimated by.
No, I can, we're just hearing it move around. That's all. It's fine. I kind of figured that at the last moment when
Our new system, we actually have access to it now.
Yeah, no, that's fine. Might take a little WD-40 up there, but other than that, well, I kept hearing it.
It's a little creepy.
What am I hearing?
You must have got more sleep last night.
Do what?
You usually don't hear things.
I'm sorry.
It's not as noisy in here.
I didn't hear what you said. I really didn't.
I said you must have gotten more sleep than usual last night because you usually don't hear things.
I did. I actually slept way too long last night, and it was a 2 cup of coffee this morning instead of 1. So. spread out. Get over there. Come on down, don't be scared. We're not gonna bite. We appreciate y'all waiting for as long as you did today.
We appreciate you inviting us.
If you will, state your individual names and then we'll get started, please.
Mary Beth Donaldson.
And I'm Don Lohr with Herbie Wiles Insurance.
Art Hoth with Inetico.
And we have one in the restroom over here.
We have Joe Hodges, who is also the president of Inetico. He's here as well.
What's his name again?
Y'all can pull that microphone up.
Joe?
Joe.
Joe.
Yes.
That is not the name I wrote down, so I'm glad I asked. I'm sorry about that. Okay, good. Right now, we're looking at self-funding, and some numbers that were provided to us were a little different than what we could try to figure out of the claims experience for a year.
Okay.
So that's where we're trying to figure out the hard cost of going self-insured.
Okay.
And what I'm looking for on any of the plans that you provided with the 150,000 stop loss is what are the hard cost and monthly hard cost and annual, and what is the expected claim number monthly and annual that we need to put away inside of a fund.
Okay.
And then you can talk about the services that you can help with that helps cost containment.
Okay.
Okay?
Yes,
So
sir.
that's where we're at today.
Okay.
We've all learned the 12-12 and the tail and the
Okay.
incurred but not reported, so we're pretty much up to speed on that.
Okay.
So that's where we're at, okay?
All right. Okay.
You got it.
So if you're looking at the proposal from South Georgia Benefit Administrators, you want to look at this page that has all of the numbers on it. All of this is what you all would be responsible for with your self-funded health plan. The fixed costs are up at the top of that page. If you'll go down each column, we have your current plan. The next column is Sirius International. They're a stop-loss carrier, so they would handle any claims in excess of $150,000 that you may have. The next column is Companion. They're another stop-loss carrier. Those two columns are for the plans that Putnam County currently has, okay?
Okay.
The next two columns are for the plan that you all requested in your RFP that we come up with. So it is only one plan. The fixed costs for both of those plans are the same. The only variance is the claim funding factors that were used, okay? So when you're talking about stop-loss coverage, you have an actuary who takes the information, they take the data that we were provided from Florida Blue by Putnam County. They take all of the claims data, they take the large claimants that were included in that claims data, and they put it into a formula to figure what they think your maximum exposure is going to be should you change to a self-funded health plan. So if we're talking about fixed costs first, if you chose to go with the number 4 column, your fixed cost monthly would be $66,000. That's what you would pay for administrative fees, for broker fees, for PPO network access, for utilization review, for a fully insured transplant product that would protect you should you require a transplant, and then an ambulatory surgery carve-out program. So $66,000 per month $801,179.22 would be annually. That money would be paid, period. Okay? Now you go on down to the area where we're looking at claims. So they have aggregated your data that we sent them from Florida Blue, and they've come up with a funding factor that says each member for employee-only coverage would use $588.67. That is what they're estimating your premium to be, okay? So you take your fixed cost and you add it to that bottom funding factor. Expected claims, if we're looking at column number 5, your expected claim cost based on the data that was provided is $4.8 million. That's what our actuarials with Companion Life have determined to be your expected claims based on the data that was provided. So if you take that plus your fixed cost, your expected cost of your plan is the $5.6 million. Maximum expected cost would be $6.8 million. That is a worst case scenario number. They figure that at 25% of what your attachment point is. So they're just saying if you have a really, really bad year, which historically you have not. Historically, based on the claims data, in 2014 you only had 2 people who had claims over $150,000. 2016 you only had, or 2015 you only had 1. 2016 you had a rough year. You had 5 people who had claims over $150,000. So historically you don't have sick people. You have a few every now and then, but for a group your size to only have 5 claimants with over $150,000 in claims is not bad at all. Even if you do have some, though, you're still protected. That's what you pay for stop loss. You have coverage for any person, any claims over $150,000. Money comes back to you if you pay out over $150,000. So I know that self-funding seems scary. It might, but we have so many different cost containment measures that go with our self-funded health plans that protect you from a from a transplant or from dialysis or Harvoni, the miracle drug that cures hepatitis C that they don't tell you costs $100,000. So we have these products in place to protect you in case you do have a bad year. You also, with this premium, you have aggregate coverage, which covers the whole group. So if you had a really bad year and went over what your attachment point is, you would get that money back as well. So there are ways that we are protecting you and protecting your money by having all of these other services included.
Ms. Allen, you had a question?
I do. One of the things we noticed in your bid, it was an all or nothing, that we had to take all of your product offerings and not just one or the other. Could you explain why that is or give us a little explanation?
The reason that we did that is because when we put together a self-funded package, we try to do the whole package. Medical, dental, vision. You have one ID card. Your member's not carrying around several different ID cards. They have one that they use when they go to their providers, and it covers all 3 of those services. If you all don't want to have that, then by all means we could handle just the health. But it just makes sense, if you're going to self-fund one, why not self-fund the whole program? That way you have that one ID card. You have that one contact. Your members don't have to call 3 different places to get answers when they have questions.
But now this number doesn't include all the other ancillary
This
products.
number does not include
just
that.
health.
That's correct.
None of them did, though, to be
Right,
fair.
right. Well, this was the only carrier that all-in-one, wasn't it? Yeah.
Yes, that is correct.
Okay.
That we can say.
Ms. Allen, more questions?
No, thank you.
Okay. Committee? I've been kind of quiet around here today. Okay. Anything else you'd like to share with us before we're...
Do you guys want to add anything? I appreciate you all taking the time to hear us today. I have worked with many municipalities over the years, and the savings that could be obtained with a self-funded health plan, we call it self-funded, but it's really partially self-funded because you do have that extra reinsurance behind you that is protecting you should you have large claims. So municipalities benefit more from self-funded plans just because of the structure. You want good benefits for your employees. You want them to be able to be productive. And one way for them to be productive is to give them good benefits. So again, we appreciate your time. We appreciate you allowing us to come and present us. Herbie Wiles is right down the road. They're going to be servicing your account from down here, which I'm very OCD, so I would be on top of things as well. But I just want you to consider this option because I believe that it is a very viable option, and I believe that it would be a good fit for your county.
Chairman Harvey, I do have a question.
Yes, Mr.
Yes.
Davis.
How much lead time would you need to be able to stand up a self-insured program?
I've put them together in as less than 1 week. I don't like doing that because I can get your plan document ready, I can get your ID cards ready, I can get people loaded in my system, but the partners that I work with tend to growl at me if I say we're implementing this in a week. A good lead time is about 30 days.
Thank you.
You're welcome.
I did have a question about
Yes,
the
sir.
networking.
Yes, sir.
Your networking would still include all the doctors that we're using now?
Yes, sir. I think we discussed this previously when we came down. First Health has a tremendous network. They have a huge network. It's national. I feel like in this area, if you have any providers that are not in network and some who may be in network, we could get greater discounts by doing direct contracts with them outside of the network. So if you're currently seeing a physician in Putnam County and they're not in the First Health network, we would contract directly with that physician. Your members would still be able to see the same physicians that they've been seeing.
Okay. All right. Committee members?
I just wanted to know what the timeline to set something up like that would be approximately, to get all the physicians, hospitals, or groups, or whatever contacted specialists. That
It varies. Typically, if the physician is willing to work with us, it can be a matter of days. I recently contacted a physician. One of my members is in South Carolina, and his gastroenterologist, who has a huge, there were like 20 physicians in the practice, and none of them were in the First Health network. He calls me and says, Mary Beth, we've got a problem. And I said, no, we don't. I picked up the phone. Within 5 minutes, I had a direct contract with that provider. So if your physician is willing to work with us, it can take days.
Do you know the hospital networks that are in First Health in this area?
They were provided in the RFP. I'm not really sure what they are. And you have to remember, you have to think of this also. I received a claim last week that was around $60,000, and the network discount was only 10%. I reached out to that facility and said, if I can get this claim turned around to you by Monday, can you give me an additional 15% off? And they agreed. So even though you have a direct contract, they have a direct contract with this facility. If I see a need to do additional discounting, I will reach out to that provider and make that happen.
And actually, if I can jump in, I believe the hospital network is HCA, that is
Yes.
the widest range, and it is in the First Health Network. So we did a geo-access across the board to ensure there was good crossover between what the members are using today and what they would be exposed to. And there was very little fallout, if any at all. And again, going back, if we did experience somebody that was setting up care or needed care with a physician or with a facility that needed access, in the clinical side and the cost management from utilization management, those nurses, when service is being requested, will jump in, arrange an agreement with the provider to ensure that member's service is covered for their care and treatment.
Thank you.
All right. Thank you very much.
Thank you.
We appreciate it. This is going to end our closed session. So we'll invite everybody back in the room. But in the meantime, we're going to recess for 3 minutes.
Heard that for years. Never seen anything. Yeah, it's all set up. I've been out there today. $20 million. I was a little after reviewing it this weekend, but the point one of this does not mention at all. Is it two separate cost sharing programs? Okay. Figured that. I got about 3 things on separate trains. This is just for the sewer. Doing great. That was discharged down the street with that impaired. I'll tell you what set up today. I'm very lucky. I went down there during Hurricane Matthew in the truck. Paradise Point, the photograph that you can have. Good. I couldn't get to it because it's so flooded. But I have some very compelling photographs that'll help our conversation tomorrow. I'll enjoy it. I've met a few problems. Good.
Shook hands with her one time.
I'm leaving at 10. Actually, I thought we weren't going to be on. I don't know. It said the board. Committees start at 9. Okay. I drove by your house.
Oh, she showed you where it was. Yeah, I showed her from out back, with, you know, so you could recognize it.
Committees start at that time, and then. I'm gonna call up.
I was gonna run something by you.
I think everybody should.
Yeah, yeah.
Stacy, can I borrow it for just a few minutes?
That's like Johnson. Monday's bad enough, yeah.
Kerry Johnson is son. Yeah, I didn't know when I got back. Without children. My wife was I like my passages a little bit too. I'm from motion sickness.
Another death rate?
Tony, are you ready? Okay, we're going to reconvene our meeting. And since I can find my glasses. Everybody back in their seats. I do want to thank you all very much. The reason, like I said, we went to this meeting today was because some of our numbers were all over the place, and we needed some finality on that to be able to advise the Board of County Commissioners in the proper manner. Stacy, if you want to wrap this up, Ms. Papel, for us and tell us what we heard today and what you've
Well,
heard.
What I heard today was self-insurance is very attractive. I agree, it's very attractive.
You gotta pull that better to you.
Self-insurance is very attractive. We've heard that these numbers don't include the tail. We've heard our claims could be more. We've heard that self-insuring is taking the risk ourselves. We've heard a little bit of, we've heard that we probably ought to be working with a consultant. We've heard a lot of things. We've heard a lot of attractive things. We've heard we might want to consider a capabilities presentation. As I said last week, I don't recommend we go to self-insurance this year. For all the reasons that I shared last week, for all the reasons I listed in my email to each of you, we don't have a lot of time between now and when we have to start taking this money out of employees' paychecks. It is a gamble. We don't have any reserves to put up against this. I think you should keep the recommendation you made last week, and I think you should charge us to move towards self-insurance in the next 2 years, because it's very attractive. But we don't have any reserves.
Okay, Ms. Papel, I have a question though. The county budget is pretty strapped, and we're looking at taking a bite out of the apple as hard and as large as we can. And in some of the presentations today, it seemed like we could take quite a big bite out of the apple on our. Now I understand the reserves, and I get all that. But my question to you is, by adding this third plan on a fully funded situation, could very well cost the county money that we don't have. And I think, as Mr. Smith alluded to last week, is what are we going to do about capping those costs so we don't have an expense? We could possibly see a $600,000 savings. We might see an $800,000 savings, but we could also see an additional cost of $700,000. So how do we mitigate that?
It could be even higher than that, because as one of the vendors said, with the stop-loss insurances and the aggregate insurances, you still pay those claims,
right,
and then you get that money back. So you could run into a cash flow situation where we are out cash for another hurricane, cash for surprising claims. We could have the cost of borrowing money to make payroll until we got money back from stop-loss insurance or aggregate insurance.
Well, I was more referring to the fully insured plans at this point when I changed gears, and I apologize. But in doing the math, it was good that we went out for bid because we saw a lower cost. There's no doubt about that. But when we add this third plan with a better prescription card, keeping funding as it is right now could actually cost the county some money. So at a time we can't even afford, we're trying to look for savings is my point.
Are you moving from the overall cost to the employer versus employee cost?
Right.
Okay.
So that could be, Ms. Allen and I discussed that prior to this meeting. So
I wasn't in that discussion.
No, you weren't. And but I think we got to be frugal, as Mr. Smith said in the last meeting. We got to be very careful about, do we fund everybody at the same level we're funding them now? Can we afford that?
We can't afford to.
We were given a number last time of about $3.5 to $3.1 million that the county could put in. Some of our self-funded ones showed that we could afford that with the risk that we would take. But if we stay fully insured and everybody jumps to this new one, we got a dilemma on our hands, and it's a big dilemma. It's a big budget number. I'm just throwing that out to you. I mean, I know.
That's part of budget talks.
My thing was saving money. you know, and transference of risk. And I think that the self-funded market proved that to be something viable. I understand where we're at financially. I really get that. Committee members, I'm going to quit talking because I've been talking a lot today. So I'm going to start over to my left. Bob, do you want to have any? Oh, I'm sorry, Tony. Tony's over there in the.
I don't have none right now.
Okay, Bob?
Well, my only concern going forward, even with fully funded, is what is the split between what the employee is going to have to contribute? The numbers are not consistent with what, as in a percentage level, what's being provided right now. It's anywhere from about 78% to 85% is funded by the county, depending on which plan was picked by the employee. We've got to get consistency here. At some point, we got to draw a line. It might be uncomfortable for some employees, but it can't always be just pick your plan and we'll pay for it. There's obviously we have to make a decision on that. And we haven't discussed it. What should it be? Where could it be?
So what's your solution to that problem?
Pick a number and start walking it back to where we have to be. I mean, budgetarily, we're at $600 a month per employee. But realistically, we've heard everybody say we can't do that. Employees are just going to leave in droves. Where's the number? We pay out as much as $1,900 a month for an employee and as little as $600 a month for an employee. Where do we start?
And that was my concern with just talking just a second ago. What if they all migrated to something that the county says we can't afford that? We're stuck at that point. I mean, we really are. We're in a bad spot in a budget year that we're trying to find savings. Press, I'm not going to call y'all individually. I'm just going to look when y'all get ready if you want to. Or
well, I've got about the same concerns Bob's got, and I've said this over and over. We have one pot of money, and we have so many employees, and I feel like it's our duty to provide at least basic health insurance for our employees, and that's what we've got to do. And we need a budget number that we can kind of backdoor this thing in there and see where we need to be and what we can afford for an employee. But other than the sheriff's department, I think I've got the most employees and probably the lowest paid employees. They cannot afford anything more than what we're doing right now or increase. I mean, these guys make $400 a month. I mean, how do you expect them to live on that and pay health insurance? I mean, at least we can do is provide a basic health insurance for them. And I agree, if we don't, we're going to lose employees right and left. And I don't have a solution for that.
And I'm in exactly the same position as press. Again, we've got a lot of what amounts to the working poor working for us that just can't stand too much of a cost here. And that's the ones I'm worried about, because if I get any loader on people, I'm going to have to start shutting some doors.
At the risk of sounding very redundant, I think it's rather obvious that self-insured is really the only way to go. I've never quite heard the argument, we don't have any money, so let's don't save any money. We have to take risk. So the question is, are we going to pass the cost on to the employees, or is the county going to take the risk? That's the bottom line. I commend Mrs. Propel. She's doing exactly what the commission's asked of her, what she's getting paid to do, which is advocate her position. She does it very well. I disagree with her as far as the risk is concerned. There was some discussion about a consultant. Wakely is a consultant, Wakely firm, independent consultant. We have a large report from them. It basically says, they say we can save 5.2%. We see as these numbers start fleshing out, I mean, it defies logic to think that a fully insured plan is going to be cheaper than a self-insured plan long term. It defies logic. We know that self-insured is the way to go. There were two concerns that were brought up. One is, can we fund it? I think that's a legitimate question going into it. Secondarily, do we have the time to stand it up this fiscal year? That's a legitimate question. But this whole idea of it's gambling and the sky's falling and we don't have any money so we can't afford to save money, that argument's lost on me, to be honest. I don't get that. I mean, 85% of all firms that have 500 or more employees insured are self-funded. 98% of the states are have some self-funded program. A lot of them completely self-funded. If they're not saving money, if it's not a good idea, if it's a gamble, then they're always winning. I'll gamble under those circumstances. If we're going to call it a gamble, if I'm going to win, then I will gamble every time. There is risk involved. So if you look at this from the perspective that you get close to your stop loss, but you don't exceed it over a large period over a large number of claims, then yeah, you can, it could happen. But if you look at the Wakely report, the percentages are minuscule. It's almost, it's just almost impossible to happen. Could it happen? Certainly. A lot of things could happen. I could grow my hair back. It's not going to happen. I don't think it's going to happen. So the same thing here. The only option we have, and we've heard from 3 department heads for the county that basically said the alternative is losing employees. We've had a lot of retirements in this county. A lot of people have left. So institutional knowledge we're lacking in right now. If we lost those employees who have any tenure whatsoever, then we're really going to be in a bad spot in this county. The citizens are experiencing that now. I don't know if the commissioners are hearing it, but I hear it, and they don't even call me other than to conduct business. I say all that to say this. I'm a self-insured guy. I see the wisdom in it. I think we have time this year to stand it up if we have the money to go into it. I do think we need an independent consultant. But at this point, the county has to decide if are we in this for the employees and for the taxpayers at large? I mean, it's their money, right? I mean, if we save $1, the taxpayers save $1. Our widget's our service. So if we can save it, I'm all for saving it. That's just my opinion.
Thank you, Mr. Davis. Sheriff?
I don't want to sound like a broken record, but I concur with what the rest of the committee members have suggested thus far. I think that it's our responsibility to look at this fully or self-funded model as a cost savings to pass on to the county. And I agree with Mr. Davis that while there may be a risk associated with it, I think that that risk is well established. And as Mr. Davis said, if you continue to gamble and win money, then why not gamble?
Thank you. Commissioner Pickens?
Well, I definitely hear from the department heads, and it does sound like if we, are not able to, to fund the insurance to the employees like they're accustomed to, that there's going to be some departures. It looks like, in our budget year next year, we are not going to be able to do that. So that's why the self-funding does look attractive. Now, I would have to educate myself more on it, to be honest with you. So I believe we would maybe need to have a consultant or have the exhibits from each one of them come back in before I can make an educated decision on that. But it sounds like that is the way to go, the self-funding. Unfortunately, as Kenny Downs said, maybe they should have started moving there 5 or 6 years ago, and we wouldn't be having this conversation. And how we get there, I'm really not sure.
Thank you. Mr. Overturf, I'm going to jump over to you and then come back to the middle.
I understand exactly, and I think I've 3 or 4 weeks ago brought this up, that to me we've almost gone backward, that we needed, and I know it's not their fault, but we needed to figure and work our way backward to see what the best plan was. I think we've learned a lot today. Brenda and I were talking about it. It was very informative. It still comes back to what we're talking about, and that is the employees or the directors keeping their employees, and you all as the 4 board members having the money and the fiscal responsibility to be able to help us do the best we can for the taxpayers and for our employees. I guess I have a question for you. We've talked about the reserve, and I know you talked about the audit and all. Does that have to be done in 1 year, or can we stretch that to try to get to the 1.2, I think was what we quoted the other
That
day.
has to be a 3-year plan that the
So
board.
it doesn't all have to be done in 1 year.
The board imposed that years ago, and
Right.
when we get below that cap, we have a 3-year plan to get back to that
Okay,
cap.
then that would be, one of my suggestions was for us, you four, to look at that and see if we can narrow that number down to help the employees out. I still remember the other day when our sheriff made the comment, and it wasn't a threat on his part, he was just being honest with us. And I've even talked with another director that's not on this committee, and they've said there might be other departments that have to leave and go elsewhere because of this. So I throw that back to you four and say, we've got to come up with that number, whatever's workable, so that we keep with the sheriff, we keep with whoever else, the rest of us, and do the best we can. And keep in mind, yes, we want to be fiscally responsible, but if we don't have to make it all back in 1 year, let's look at maybe coming up with a good plan for 3 years and try to work together with that. I'm, as Mr. Davis said, I understand that part of it, and I think that is definitely the way to go. If we can get it done this year, that's one thing. The staff's, has a little bit of hesitancy about it, but it might be that if we can work with you all and you can come up with a great idea of how we can do this first year out of the way, and then look at, 6 months from now, go ahead and start working on self-funding. And as they said, bring in all the companies and let them tell us what they can do the best, and, those kind of things where it gives you a few more months to at least work on it.
Thank you, Mr. Everter. Brenda, any questions? Any last comment?
The decision that we have to make is not an easy one. We all know that. And we all know that being a manager, you have to make those tough decisions. I don't know what the answer is. I've spent the last few weeks pushing a lot of numbers. You guys were handed a disc. The evaluation committee was handed a file box full of books to look at. And I spent several days reading those books. We got here because we said last year that our employees could not take the bite that they were looking at imposing on them last year. I don't know that we can, go to them this year, and some of the comments last year was, we're doing this in a short period of time, and we're asking our employees to make decisions that affect their homes, their livelihoods, and we know a lot of employees are not going to be able to afford if the percentage changes dramatically. I think that needs to be something that's done incrementally. I agree. I think we have to address what is fair from the employer side versus the employee side, and we see a lot of diversity there, and I think those numbers can be polished up quite a bit. I think a lot of the information we've gotten in the last few weeks, if we had it a little bit sooner, would have been a little bit easier to digest. It was very informative today. I think I learned a lot more about self-funded than was explained in any of the documents or any of the conversations we had previously. So I think bottom line, whether we go self-funded, whether we stay fully insured, the harder job is going to be on the BOCC side to decide, and Stacy, pushing those numbers as to what can be done to help staff out. I don't think any department wants to see employees leave, and I agree with Clay. Over the last couple of years, because there was no succession plan in place for this county, a lot of departments lost people that retired that took institutional knowledge with them. And for most departments, I spent 12 years in planning, a counter person, and the same in the tax collector's office. You're looking at 2 years minimum to train an employee to get up to speed. Certainly there's some money decisions with what we do with insurance, but you also look at the calculations on what we keep spending to retrain employees, and we're not gaining anything. So there's still some tough decisions to be made, and this committee has not seen any numbers about what the employer-employee share might be, and I think that's the harder decision.
I agree. Mr. Downs?
Well, first of all, Clay, if you find out you get your hair grow back, call me. I'd like to drink some of that water if you don't mind. You know, I fill in for Tim at these meetings, and so I've just been to a couple of the meetings, but I've tried to keep up with this. And talking about institutional knowledge, and the board just heard not long ago where our finance director was leaving. We planned for that 4 years out, and Susan Franks has been training in that position, and that was the reason we hired her. So continuity is what it's all about, and having somebody step in and continue that job on and try to make it as seamless as we can. I will say that the commission has got a really tough job, but I'll also say that last year when we heard in the 11.5 hour, you know, that where we were at with the insurance, that was not right for the employees, and I was very vocal about that. But at the same time, I had Blue Cross Blue Shield come and meet with every employee in our office, and I said, this is mandatory. Everybody has to meet with them. And Richard came and visited with everyone, because if you go to a big meeting, nobody wants to say, my wife's got a bad cold, or, you know, she gets headaches, or I got this, or I got that, and you don't understand what they're saying. So I had Richard come and meet with everybody privately, one at a time, and he was very gracious to come and do that. And most people move back to the less expensive policy. But we also shared with them that it's not going to be like this next year, guys. We've got it 1 year, but you need to start planning now for where we're going to be next year, because it'll be here before you know it. And the same thing with the commission. I certainly looked at self-insured a long time ago, and everybody knows it did. And we've had some very good meetings today on that, and illustrations. So which way this commission goes, you know, I hate to just throw it back and say it's what you got to do with it, but we've got to deal with our budgets, and we've got to try to make it work the best we can. I know Stacy's doing that with the county budget, and what we're basically doing is trying to rub two nickels together to make a quarter. That's basically what we're trying to do. And we've got to figure out how to do it. You know, it's like running a small business. You know, you got to figure out how to make it work. I'm just not sure. I wish I could give you a good answer, and it would be the answer that would be the one that really worked. But I'm not sure. I think I do know this, that this commission and this county has got to start this year planning for down the road. And it's kind of like I called you in December and said, when's this insurance committee going to start meeting? Because used to, the insurance committee would meet for 30 minutes and that was it. That was wrong, you know. But at the time it was okay. But now it's not. This is an ongoing process, I think, where the commission, where the insurance committee is going to have to start planning for next year. And right now we're trying to fill the gap this year, but we need to start immediately. This committee needs to start immediately working on next year what's going to be the best results. So I wish I had a great answer, but I don't.
Thank you. Commissioner Lovell?
Real short, based on the last two meetings and really the whole process, I think that this commission would be wise to hire a consultant.
Amen.
That's what I say.
Commissioner Goddard?
Well, I agree. I think we do need a consultant. I believe, based on Mr. Davis, based on the Watley report, based on the statistics that I've heard, self-insured is where we need to go. But this is new territory, so I do believe we need expertise in it. The other thing I think we need to look at, we want to make sure all employees, basically, you know, the sheriff's department, the public works employees, are that they are provided a very, very good package. I also believe we might want to look at employees that are making upper dollars contribute more, so that we can provide more for our employees.
Thank you. Mr. Tompkins, I don't think we have anybody making $400 a month in the county. I think you meant that a week. Yeah, so that's fine. You know, the bottom line here for me is savings. And what's our potential savings? Well, self-insured is our potential. That's the big bite of the apple that we can take. I understand the risk. I get all that very quickly, but there's policies in place to mitigate the risk. I think if we're ever going to see a savings, we need to see it now. But I understand tomorrow's coming, and we have an agenda item on our board meeting tomorrow, and we have time certain of problems that we've got to deal with. I will say this, that I don't know how in the world we can expect our department heads to budget if they don't know the number coming to them. And my concern staying fully insured is going to be that we still have an unknown number inside there. And how do we mitigate that? So unless the board chooses to make a different proposal, then I think we'll go ahead, Ms. Papel.
I have a question, because it seems that some of you heard the department heads say something that I didn't hear them say. I didn't hear them say they were for self-funding. More, I heard them say they were worried about how much we were going to, the employer-employee part for their employees.
I think you heard that from everybody,
Yeah.
Unfortunately. I mean, that's an unknown number to them and an unknown number to us tomorrow when we go to vote on what we're supposed to vote on. We still have that unknown number that is a risk to us. Again, we could save money this coming year, and we might very well spend more money than we did last year. I got how many hours to get my head wrapped around that? I don't know.
Chairman
Yes, sir,
Harvey,
Mr. Dick.
would it be possible, in light of the fact that some of the vendors had indicated that they could stand up a program self-insured rather quickly? Now, I know staff, it strains staff, I understand it. But would it be possible to pull the agenda item for tomorrow and then have a consultant, engage a consultant this year and have that decision made at a later date?
Well, I think, yes, that's possible. Let me say that. I mean, everything's possible. But I mean, what's probable is the question on the table. Do we have the time to reconsider this? And that's going to be the question that the board should ask tomorrow. Do we have time to reconsider where we go from here? We've heard that it could be seamlessly painless for us in some cases, and rather probably a little bit more of a stretch on the other cases. So I think everything, as long we got a deadline we got to meet a September 1 deadline for payroll deduction. Is that correct, Ms. Allen? So everything's got to pretty much be in play by the September. So back that up a little bit further. We're into August now. So August 15th, we got to have our ducks in a row. We got to know employee costs. We got to know where they're going. We got to have online enrollment done by the end of that time so we can start payroll deduction come September. Am I right in saying that, Ms. Allen?
That is correct, but one thing that's very key here is because we have a Section 125 plan, we allow employees to have their premiums prior to tax deductions. We are required, mandated, to have a 30-day open enrollment. Before that clock starts ticking, we have to have all that information done in 30 days. And then, as you all know, payroll deductions are always a month in advance. So changes for October 1 have to start September 1. So there's a lot that has to happen in those 30 days.
And you need time to put the changes.
In July. So you're thinking July.
Well, not only
It's
that,
the latest date possible.
Well, we were looking at July 15th as our open enrollment, but we're pending that. We haven't announced it yet because we may not have, even if we do a clear renewal right now. Also on the agenda are dental, vision, and life with some rate changes, and we have to have time to update all these rate changes in our electronic systems as well as get the monthly deductions corrected. So when an employee goes in, within that 30 days, they're getting the new rates. Some of them are significantly lower, some are a little bit lower, but they have to be given that information and have the 30-day window to make their change and their decision. So, and then after that, we have to proceed with effecting that change, making sure we have all the documents lined up. Either they do it electronically or paper. We do have a couple different processes, but we have to be very certain that we're deducting the correct amount from the payroll. And we do that September 1, that first week in September, for an October 1 change. And I'll remind you, we have currently 4 different payroll cycles to deal with. So that's, I know that's our problem, but it is a burden for us to make sure we have everyone adequately addressed.
Mr. Davis, that answer your question?
Kind of. I mean, I understand, but what does that mean? Does that mean tomorrow's the day? Could that be postponed? I guess that's, I mean, this date tomorrow, I mean, the dates that we've set are artificial dates that we've set, right? I mean, they're self-imposed.
Right.
The dates that I think Mrs. Allen's talking about, or Miss Allen's talking about, are dates that are required, statutory required, whatever they may be. But there's still a gap there, right? From the dates that she's saying to the dates that, until tomorrow, right? I mean, you have the end of June through the end of June, potentially some of July, couldn't you? I mean, that still could give you sufficient time, but only if it's going to be a benefit. I mean, to put it off a month and end up in the same position, the unknown is how much the county can afford, right? Right. We know we need to save money if possible. It's clear in my mind, self-insured is the way to do that. I suspect if we're in such dire straits, then I say, look at it real hard for this year, right? I mean, if we had the money to continue like we did this past year, then let's do that. It's an easy thing to do, and it gives us a year to stand up a self-insured plan for next year. But if the money's not there, and given the comments of some of the department heads, then, I mean, they were talking about fully insured, correct, but the problem is you lose employees if when you come to work for the county, I've always been told you don't make much money, but you have benefits. If we take those benefits away from employees, they're not making much money, and now they don't have benefits. What's the reason to stay? And we're seeing that. I mean, we're seeing employees leave. We lost our director of real property, went to Lee County, making more money, better benefits. Everybody's doing that. The market's moving. Look around. Pick a road out of this county, and it's booming. I think Mr. Hammonds had shared with me last week the stress that he's under as it relates to, and I don't want to speak for him, but building inspectors, those licenses are way more valuable now than they used to be because things are moving. We have to address that. I think Brenda made a great point that when you have to bring in a new employee and train that new employee and get that employee up to speed, there's a cost associated with that. And I think this county's paying that cost. Not only with that, but the taxpayer's paying the cost. The customer's paying the cost. The customer's not receiving the service he or she is deserved. So, I mean, that answers my question, but I don't know if I don't know that there's still not time. If this, you know, I'm self-insured. I think you continue to review it to the very last minute this year. And if tomorrow's the last minute, tomorrow's the last minute. But I think you still have time to stand up a program, even if you were to continue to research this and look at this thing. This is a big problem. I mean, these things are very, very technical, and it's in depth. So, you know, my suggestion is, you know, to continue to look at self-insured for this year.
Mr. Tompkins, you had your hand up?
Yeah, I just wanted to say, you know, for the record, I have absolutely no objection to self-insured. And from what I've heard today from all these consultants, I believe that's probably the best way for us to go. My only concern is, I keep iterating, is what's fairest to our employees to keep our employees. And I agree with everything they said. We're starting to lose equipment operators. You know, our basic core people, they can jump ship right now and get $5 more an hour, and I can't compete against that. You know, and Clay's right. Everybody said the only reason we have county employees, we offer good benefits. If we lose the benefits, we're going to lose the employees. That's the basic line.
Mr. Stender?
Just for the record, self-insurance, it seems to be the clearest money saver. How do we get there, and can we do it right now? It's really the only question. I mean, when you look at the dollars and cents, it's certainly going to save us money. Once we get our health in shape and everything, it's the way to go.
Ms. Allen, we're going to wrap this up.
Yes, if I may. When we first talked about whether we should go out to bid or not, I was asked, do we have enough time? And at that time, I said, it's not my recommendation to go out to bid, because to do this properly, it takes time to make sure that we adequately provide all this information to our employees. However, we went out to bid. We had a deadline for that RFP, but we had to extend it by 3 weeks. Was it 3 weeks, Marjorie, or 2 weeks? So our target date to get this to the commission for approval moved over 3 more weeks already in the future. Even if money wasn't an object, tasking us to get this done and educate each employee on any type of change with their vendor and how it works is still a very difficult situation. We have proposals for a new carrier for vision. We have a new proposal for life insurance as well as dental. So that's going to take in itself expensive time during our open enrollment session. And again, if money wasn't an object, I would still be asking you to please give me more time, because we just can't turn that around right now. And speaking of the money thing, this committee, from what I have heard, is not tasked with deciding how much the commission is going to provide to the employee. And if it's 100% employee only with 50% dependent, I believe that's part of the budget process. And I think we've been hearing for the last couple of years that we can no longer continue to subsidize at the rate we have been doing in the past years. It would make our life in HR easy, because we wouldn't have to explain this to the employees and put that burden on them. But the reality is we just don't have the money there. I don't know what else to say about it, but we're all facing this problem. It's not just a HR problem in one department at all. We're all in this together. And I wish I had the answers. I really do, because we are required to meet with each employee face to face, or at least get their paperwork from them and explain all of this. And we know it's a significant strain to them. We are prepared to offer some other alternatives for the employees that are at a lower pay level. There's federal funded programs that you heard of when we started our committee. So there are other things in place, but to ask that question, do we have time, I would respectfully say we don't. We can't stretch this out anymore. I mean, we've been working on this. I came back from medical leave 6 days when I should have been out 6 weeks to work on this, and I don't know what else we can do. We're working weekends, and there's not much more we can give. We really respectfully ask you to consider our recommendation. Thank you.
Ms. Vaupel, and then we're going to wrap it up.
And she could conceivably have to go back out on medical leave. You know my recommendation. I've shared it with each of you.
We do. All right, so we have a proposal on the table from last week, and that's going before the Board of County Commissioners tomorrow, unless someone else wants to make another motion or the committee changes their mind. And hearing none, we will, is there any further discussion in this committee?
I would like to ask if we could reconvene probably after open enrollment to get going on the continuation of the topic of self-funding. I think it's very important that we continue that process, if tomorrow we could ask.
Tomorrow we will discuss at our Board of County Commission meeting the recommendations of this committee and charge the committee with how we go forward at that point. So if there's no further discussion, we stand adjourned.